And as a result, the ECB no longer needs to think about inflation getting too sticky, too permanent. They can afford to cut rates somewhat.
When you look at the ECB, though, it's pretty much certain they're going to cut in June.
Yes.
What happens after?
The ECB, in my view, will be in the slow lane. That is, we do not look for back-to-back cuts. We expect sort of quarterly moves in the next one, September, then December, early next year, because inflation will now probably hover around the current level. The economy will be picking up. It will probably be only late this year when falling household prices for gas and electricity will probably bring headline inflation to or slightly below the target rate of 2%. And that's when probably the ECB will then do a lot more cutting. At the moment, they have pre-announced the June cut, but they'll be in the slow lane for a while thereafter.
Holger, I'd like to circle back to something you said in the beginning about how for this huge fiscal impulse, you need a sweep of Congress, which Adam Posen also agreed with. But there's one area that could be inflationary that you don't need a sweep in Congress, and this is tariffs, and that would affect central banks around the world. How are you thinking about potentially a Trump administration putting a 10% tariff ring around the United States and 60% tariffs on Chinese imports?
Well, tariffs are bad. Sometimes there are good reasons for tariffs. Yeah, there can be reasons, sort of, if really there is too much of subsidies going on, yeah, but basically tariffs are bad. Tariffs make all of us a little poorer. But the impact, however, on US inflation, this is a huge domestic economy where imports play only a modest role. The impact on US inflation, maybe in the 0.1, 0.2 percentage point range, I don't think that would really make the crucial difference. It would be a bit bigger in smaller economies if they protect themselves, in inverted commas, protect with huge tariffs. Their impact on their prices would be bigger. So this is a huge concern, the tariffs, but less so for the inflation outlook.
But when you say tariffs are they bad if China is dumping supplies on European, US markets and absolutely obliterating their own industries?
Well, the first economist's response to that is if they give us a little gift, yeah? If we can get the electric vehicles cheaper, the solar panels cheaper, thank you for doing that. We don't have to spend the money on it. You in China spend the money on it with subsidies. The snag is, of course, if that causes too much of a disruption, yeah? Then, of course, you might want to slow down the process, or if there are security concerns involved, and probably less so for solar panels, but with cars, electric vehicles, who is getting what data, yeah? Do I want China to know where 25% of the European cars are currently parked? Probably not. So there are serious security concerns which need to be addressed with China. It doesn't have to be tariffs. It has to be, for instance, like forcing them to make absolutely clear who gets what data, or that the key data-relevant components actually have to be produced locally in the US or in Europe. That's, in a way, I think, a better strategy than to have these blanket tariffs.
Holger, you've got client meetings here in the US. How much daylight is there between the US perspective and the European one on this issue?
Well, I think there is among clients, among economists, not all that much disagreement. There are, of course, more political considerations. Well, you have the election campaign over here, which play a role. There are, to some extent, political considerations in Europe. We also have this not quite as important European parliamentary election, but among, I would say, the majority of investors and economists, there is a rough consensus. Basically, tariffs are bad, but there are exceptions when you really sometimes have to strike back. And especially if you want the other side to offer concessions, you have to show your weapons. But after showing your weapons, you should sit down at the table and talk rather than just wield the weapons.
Well, you know the German economy better than most. What do you think the German automakers want right now? The walls to go up in Europe and access to China?
They'd be the most unhappy with any tit-for-tat trade war, of course,
no doubt.
With China. No doubt. Having said that, this is not the key concern, I would say, for Europe, and it's also not that much the key concern for the German economy. We have to distinguish between two things. The one is the profits that companies make who are listed on the German stock exchange. The other is what's actually the impact on the German economy, and that probably would be much less, the impact on the German economy. We have a shortage of skilled labor, for instance, yeah? that would be much less than the potential impact on the profits of companies who do a lot of business in China and may do less business in China in the future, if, what hopefully won't be the case, if this escalates.
Interesting perspective. Holger, thank you. It's good to see you, as always. Holger Schmieding there of Berenberg on the latest out of Europe, the United States, and Lisa, the trajectory for policy too.
You know, it's fascinating. I'm glad that Emery brought up tariffs. There's one other aspect that some of these politicians do unilaterally, and that's immigration policy and how much immigration has brought down inflation in the country. Deutsche Bank actually just put out a report saying that inflation would have been 25 to 50 basis points higher if it hadn't been for the wave of immigration in addition to what was normal. These are some of the discussions that I think are really going to be fascinating.
Absolutely. Immigration kept a lid on wages, and what the CBO came out with was they were expecting a little bit north of 1 million people coming to the United States. It was north of 3 million people coming to the United States, and that's the supply the labor market needed to make sure that they can keep this lid on this wage spike spiral.
This conversation will continue. Coming up next in the second hour of Bloomberg Surveillance, here's the lineup. Sarah Hunt of Alpine Saxon Woods, Tobin Marcus of Wolf Research, Dan Ives of Wedbush, Ashok Bhatia of Neuberger Berman, Dan Ives of Wedbush, 7:30 Eastern Time, Bramo, with a lot to say about what he calls a masterpiece quarter for NVIDIA.
Let's have predictions on his outfit. It's not going to be a regular suit, I guarantee that. How many colors and patterns just to sort of celebrate the joy that is, you know, another raise, another beat.
I love when he says that. He calls it the masterpiece for the Louvre. It's like NVIDIA has become the Mona Lisa of the stock market.
In many ways it has. In many ways it has. Equity futures right now on the S&P positive by 0.6%. A lift in this equity market. The Nasdaq doing better as well. With NVIDIA in the pre-market positive and higher by 7% in early trading. Let's see if these gains hold. Just a sneak peek at the bond market for you following the Fed minutes from yesterday. Your 10-year 441.78.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like,
Yes.
so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
starting to see cracks in terms of the consumer.
There are more risks to the downside on the labor market. Do see signs of consumers faltering.
Downshifting in the consumer after the run of the consumer is very unlikely to be portending a massive downshift.
We think the consumer is discerning right now, and we expect that trend to probably continue for most of the year.
When will high prices lead to consumers pulling back? It looks like we finally hit the point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City. Good morning, good morning. NVIDIA is higher in the pre-market by 6.8%. This equity market's looking to reclaim all-time highs at the opening bell in about 2 hours and 30 minutes time. And Dan Ives of Wedbush joins us in about 30 minutes with this to say, Bramo, the godfather of AI, Jensen NVIDIA, delivered another masterpiece quarter.
A lot of people are agreeing with him. You might have think of him as a sort of perma-bull when it comes to technology, but every quarter they have blown it out of the water and talking about a technological revolution that is fueling a more than 600% increase in 1 year in net profit. I cannot get over that, to just speak to some of the cash bundles they've got.
There was this concern going into this as well as an air pocket, potentially. Would these big buyers wait on the sidelines for the newest generation of a chip? No. And what we heard yesterday from the CEO is that demand is outstripping supply. And this company, the Wall Street Journal this morning, puts it, they don't have patience. It's not there. People are desperate to get in on this, whether or not it's an older generation chip or waiting for the new ones.
Just going through things piece by piece when these numbers came out yesterday, beat and raise once again. They say they're poised for the next wave of growth. After this massive wave of growth already, they boosted the quarterly cash dividend. Lisa, they announced a 10-for-1 stock split. What didn't they say that this equity market seemed to want?
Nothing. I mean, basically, they're talking about even maybe even gaining market share from AMD and Intel, moving into personal computers, talking about CPUs, not just the graphic processing units. To me, I think you raised this point a couple of months ago. Their main clients are the big tech giants. They account for about 40% of the profits. The hyperscalers, the cloud computing service is still the mainstay of NVIDIA's profits. That's been an awesome thing for them because these companies aren't going to be affected by any kind of economic cycle in the same kind of way. They have the money to spend, and right now it's just how much can you acquire, not any kind of restraint.
We spent a lot of time talking about Fed policy. For good reason, we'll continue to, no doubt about that. But when you go through the last month or so, it's been about the earnings from big tech. The likes of Meta, what we've heard from Microsoft, from Alphabet, from NVIDIA in the last 24 hours. The numbers have been pretty phenomenal.
And it's independent, as you said, of Fed policy. It's completely independent of a lot of macroeconomic factors. We're talking about target cutting prices. We're talking about potential pockets of weakness. We're not seeing it in places that are undergoing what they call a technological revolution. Again, how much does that divorce the equity market from any softening in pockets that we see, certainly with small cap stocks?
And these are the big tech companies. Yesterday, NVIDIA talked about the fact that there are 15,000, 20,000 generative AI startups that are desperate to get in on these chips. Where is the next big potential tech company, Magnificent Seven, coming from? Maybe one of these.
The stock is up by about 7% in the pre-market. The broader scores look like this. Let's start with the S&P 500. Futures positive and near session highs, up by 0.6%. In the bond market, a bit of calm for you on a 10-year, 441.78. And in Europe, better data. We'll talk about that later. 108.46 on the euro against the US dollar. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Sachs and words on why the boom is still on the NVIDIA rose. Tobin Marcus of Wolfe Research as Nikki Haley throws her support behind Donald Trump, and Ashok Bhatia of Neuberger Berman on debt sustainability concerns. We begin with our top story. Sky-high expectations once again, not high enough. NVIDIA soaring after delivering yet another beat and raise. Sarah Hunt of Alpine Sachs and Woods writing this. Margins look quite strong, although there will be a point at which the undersupplied market becomes less so. In other industries, companies do not get as much credit when they are over-earning, but the bloom remains on the rose for NVIDIA here. Sarah joins us now for more. Sarah, let's just start with those stellar numbers once again. The bar gets higher, they keep beating it. How impressive was that yesterday afternoon?
I think it was pretty impressive, and I think that the concern was that there might be some slowdown in the change of, and it's been the rapid change higher has been so fast that the question is if that slows down, do people get worried? People are not worried, and I think the fact that they're able to absorb those
when they have something new coming, also tells you that people want to get into this game, and it doesn't matter if they have to wait for something. They'll take what they can get right now because they don't want to get left behind in their own development. So I think that it was a very strong report. It needed to be a strong report. Like all of Q1, these stocks needed to perform. They did, and that is driving right now, which you can see is another series of potential all-time highs today.
You can see it on the screen, up 7%, NVIDIA, Broadcom up 2%. ADMD up by 3% in the pre-market as well. Sarah, when you go through these names, there's an AI theme. What is and what isn't driven by this theme in this equity market right now, given utilities are up by 7 to 8% so far this month?
I think it's a lot of the stock market is hanging on not just the idea of AI in and of itself, but the productivity gains that it's going to bring and the fact that that can help with its economic growth. And I think that's been the biggest question, is what happens coming out of this pandemic and what is going to fuel the next leg of growth in the economy. And this is at least giving the market a story to tell itself. Whether or not that's going to happen in the time frame that people are looking for, you know, someone was talking about how long it takes to permit electricity changes. It's enormous. There's a long time frame that's going to take, but you've got an infrastructure build that's going to go on here. And I think right now, as we get more use cases, that seems like something that we can continue to think about. If it turns out that this doesn't work as well, or it's not giving that productivity, that'll be a different story, but we're not even close to that discernment yet.
What I find fascinating, Sarah, and John was alluding to this, the idea that we talk about the Fed rate hiking cycle that left rates the highest levels in decades, and why is this economy so insensitive to that? Well, you overlay a super cycle that is completely secular, that is independent of the macro cycle with respect to NVIDIA and all of the investments from big tech. How much can that keep going regardless of what happens in the macroeconomic backdrop, regardless of whether there is a downturn in some of the areas where we're already seeing softening?
Well, that's an excellent point, and that's exactly sort of when people start talking about, is the economy rate sensitive the way it used to be? In this particular sector, it isn't. In fact, higher rates for companies that are both cash generative and have a lot of cash sitting on their balance sheets is helpful to them because it's giving them some return on their cash, where for the last decade and a half, they were getting nothing. But it's these giant cash generating juggernauts that are really fueling the spending boom. And that's not going to be affected by higher rates. So I think that there is, you know, had this not come about, this AI cycle, I think the market would be struggling because the question would be, what's going to happen to the economy next? This is giving people a reason to say there's a lot of ways that we can see efficiencies here. Unfortunately, I think a lot of those efficiencies are going to end up being with less people working, but that's a question as we move forward. It's not a question right at this minute. Right now, we're building the infrastructure. And if I think about the build out for the internet boom and how dark fiber and all these things that were ancillary to the internet growing, you had a lot of companies that were generating no cash. You had a lot of customers that needed to be financed. Right now, you've got customers that don't need any financing. They've got plenty of cash. They're willing to spend it. And I think that that's in and of itself a cycle that is not necessarily rate sensitive.
We were talking earlier this morning with Adwaita Bahuguna about whether the 60-40 is kind of dead. And I would take that a step further and ask a question about whether some of these big tech stocks are the safety plays at a time where there's more uncertainty on the fiscal side, there's more uncertainty on some of the monetary policy than there is in just the ability for these companies right now to make bank, even with their cash piles.
Well, I think that that becomes a question of valuation. And there's been a lot of discussions about valuation, how valuation in and of itself doesn't stop cycles. But there is a point at which that there is a higher risk to the reward. And I think in some of these names, you're starting to get there just in terms of another kind of economic slowdown or some sort of hiccup in terms of some of these bottlenecks that we're talking about solving on the utility side and elsewhere. If you start to see companies having trouble getting data centers and getting room in data centers and getting them built, which I think that there's some discussion on the edges of right now, you could see some timing delays, and that could put into question the high valuations right now. But in terms of the longevity of this cycle right now, just from what you're hearing from NVIDIA and the discussions about what people need, and the other companies that are trying to get into this, I think you've got a runway on the demand side that's difficult to say there's going to be a problem unless there are bottlenecks.
Sarah, when you talk about the potential for AI disrupting the labor market, John Authors recently wrote about this and talked about how NVIDIA's place isn't exactly so healthy. This would mean taking capital expenditure from other companies. This would potentially mean taking jobs away from the American workforce. When does that story actually start to bite?
Well, I think all of technology has been a continuum of finding ways in which to make productivity better, which also very often requires letting people go or having less people. But I think that, Mandeep Singh had a great discussion yesterday about how annoying chatbots and all the other things that we've been looking at as AI have been to users, and how that experience is going to get better. So some of that's already happened. It's just you're going to start to see a better situation in places where you've already replaced people with technology. The question going forward for AI really is how much more, how does that broaden out? And to the extent that it does, how damaging is that to the labor economy? And I think that that's a question we don't really have an answer to yet.
Is there a company now that you think could potentially get on the AI space that is not, and that we have yet to see within the tech world?
I think everybody is trying to get into the AI world, and the question really is how can they use it? And this goes back to the use cases and whether or not they generate money. I mean, you've seen on the web hosting side, you've seen in Microsoft and ChatGPT that there's money to be generated here. The question is, are companies going to find it useful, and are they going to continue to invest in it? And right now, the answer is yes. Down the road, where does that end? I think every single company, I mean, we've already been using AI for the last decade or so in different ways. This is just the large language models make it an iteration better, and makes everybody try to get into it in places that they weren't because they didn't like the use cases that were there before. So I think that there is not anyone who isn't going to be working into this space. The question will really be who ends up using it better. And I don't know the answer to that. And it may very well be that some of the old economy stocks start to get much better data and use it better. We don't know yet, but I think that's the promise, and that's what people are expecting.
Sarah, just quickly, it's something Lisa mentioned a few times this week. We've talked about it before, how utilities are going to perform at a down market. And we got an experience of that yesterday. They actually helped lead the losses on the S&P 500. Given the way they've been bid up on this theme, are they defensive still in the equity market?
I think it's hard to make the case that they're defensive. And as I said, for the utilities especially, you've got a lot of issues that go into permitting. You've got a lot of issues that go into spending. There's a lot of discussion about how we're going to have to build out a better grid, and we are. That's not a question. But the timing is the question, and the regulatory backdrop is going to be the question, and how fast you can get things done, because there are awful lot of projects that people would like to do that get hindered with all sorts of NIMBY issues and everything else. So I think that there's a timing issue for that, and there's an extent to which those get bid up that are also on the yield side. You put those two stories together and it makes them a bit vulnerable.
Got it. Good to catch up as always. Sarah Hunt there of Alpine Saxon Woods, following those strong numbers once again from that name, NVIDIA. That name right now is up by 7.3% in the pre-market. Let's get you an update on stories elsewhere with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. UK Prime Minister Rishi Sunak has called for a general election on July 4th. In a statement outside of a very rainy 10 Downing Street, he said that the country needs clear leadership. Meanwhile, Labour leader Keir Starmer kicked off his own campaign, saying his party can put an end to the recent turmoil. His shadow chancellor says the Labour Party will fight the campaign on the economy, arguing that recent high inflation and lackluster growth are a product of a Conservative government. The Biden administration is touting its independence from the Fed. In a blog post, White House economists cited research and historical data to make the case that central banks' independence bolsters their credibility with the public. The move comes amid heightened speculation over how Donald Trump could ramp up pressure on the Fed if he wins another term in the White House. New York City's tax revenue from tourists has surpassed pre-pandemic levels to hit a new record. A jump in domestic visitors offset a drop in international and business travelers. More than 62 million people visited the city last year, generating a record $4.9 billion in sales and other tourism-related tax revenue. The city is expecting the rebound to continue on to next year, projecting 68 million people will visit New York in 2025. And that's your Bloomberg Brief. John.
Danny, before you go, quick question. 2, have you seen Dan Ives in the green room? And what color is the jacket?
Dan Ives and I are matching today. We thought since we'd both be in the green room, you know, we'd dress in green.
We're wearing green.
Yeah.
NVIDIA's green this morning too, on brand. I told Dan recently that if the numbers get really bad, he's got to dress in black, and I'll give him a skinny tie too.
Good.
I think we're a few quarters away from that, maybe even a few years, based on what he's got to say, maybe even a decade, who knows?
That's what I was saying. It's going to be as bright as possible just to basically thwart that dare that you said. And he agreed to it. He's never going to be seen in black.
Dan Ives, about 15 minutes away. Up next on the program, a high-profile vote for Donald Trump.
Biden has been a catastrophe. So I will be voting for Trump. Trump would be smart to reach out to the millions of people who voted for me and continue to support me.
The latest from Nikki Haley, up next from New York this morning. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York City, with equity futures positive by 0.6% on the S&P 500. There is a lift in this equity market, a lift for Nvidia as well. That name is up by something like 7% in the pre-market. Under surveillance this morning, a high-profile vote for Donald Trump.
Biden has been a catastrophe. So I will be voting for Trump. Trump would be smart to reach out to the millions of people who voted for me and continue to support me, and not assume that they're just going to be with him. And I genuinely hope he does that.
So here's the latest. Former presidential hopeful Nikki Haley throwing her support behind Donald Trump ahead of the election, flipping the script, having previously said Trump was not qualified to be president. Tobin Marcus of Wolf Research joins us around the table. Tobin, good morning to you.
Good morning.
If Nikki Haley's on a Trump ticket, let's say she gets picked as the VP, how many of those people actually go with her?
I think that helps him in terms of the complementarity that he's always been looking for on a ticket, but I don't think she brings a bunch of voters with her. The people who voted for her in these primaries, especially the current primaries where she's not even on the ticket, I think are less Haley loyalists than Trump dissenters. So I don't think they necessarily follow her over just because of what she said yesterday.
Tobin, there's a nuance to this. She says she's voting for him. She didn't explicitly endorse him. Is that how you read it?
Yeah, and I think that's why it remains very unlikely she's going to end up getting the VP nod. I think Trump's made it pretty clear up and down the administration that he wants loyalists. He wants people who are on the team. He's not trying to sort of reassemble the team of rivals dynamic from 2017, 18, 19, when we had a bunch of people who thought their job there was to check his kind of baser impulses. And whether or not she's going to vote for him, I take her at her word, that's not an unconditional endorsement.
But she also called him unstable and unhinged. Can this do damage to her reputation?
Yeah, it can. Among certain moderates, I can imagine that it would. I mean, certainly, I don't think it reflects particularly well on her, but by the time she next is going to be seeking office in 28 or later, I doubt this is going to be the thing that, really hangs over her.
So if you take her off Trump's VP list, we recently ran polling, and actually Ben Carson has the highest favorability rating with Republican voters. Where's your thinking about who Trump could actually pick?
Yeah, I've always thought that he's looking for someone who, on the one hand, brings demographic and or ideological complementarity, but on the other hand, is a staunch loyalist that he has no doubt is going to kind of toe the line for him and not sort of be afraid to defend him, not be ashamed to defend him. So, I think that list includes Tim Scott, Elise Stefanik, I've always thought was pretty promising. Looked like more of his dark horse way back when I started making that prediction, but now is sort of firmly in the running. And he seems quite enamored of Doug Burgum, which is a little bit less complimentary, but I think does help double down on the economic message. That's the kind of core of his appeal.
It seems like Terry Haynes would agree with you. He basically said that it doesn't really mean anything for Nikki Haley to endorse Trump because it's not clear, or even just to say that she's going to vote for him if it's not clear whether she's going to actually work for him. What does it say, though, about the sort of zeitgeist in the Republican Party at a time where everybody, I think at one point, the Republican House representatives we're going to lose a majority because so many of them were at the courthouse supporting Donald Trump. What does this say about where the gravitational force is?
Yeah, in general elections, in presidential elections, you see people come home. That's the dynamic that we always see. I had various people seemed right to me because generally you get partisans coming back to their home base. I think from here on out, that dynamic stands to benefit Biden a little bit more than Trump. I mean, that's why I sort of suspect that Biden's current numbers are a little softer than Trump's, even though he's still narrowly behind in the decisive set of states. But, generally you see a lot of people sort of wringing their hands about their complaints with the nominee, but ultimately you have good reasons to be in the party they're in.
What are you expecting from the debates in late June? How important are they?
Yeah, I mean, generally debates tend not to have as much importance in actual vote trends as they are made out to. You usually see a bump, but the bump tends to be short-lived. I think a decent amount of that, both after debates and conventions, tends to be sort of shifts in differential non-response bias, like the partisans of the person perceived to have won are more excited to respond to polls in the immediate aftermath of the event, but actually persuading people is fairly challenging. You know, in this case where you have, I think, a lot of people who are going to be unfavorable to both candidates and like are a little bit less attached than they might otherwise be, it's probably slightly more important than usual. But I mean, I suspect that the debates are not going to reflect incredibly well on either candidate. Certainly that's what happened in 2020.
How is Biden going to change this story? This was a Harris poll conducted exclusively for the Guardian newspaper out of the UK. Nearly 3 in 5 Americans wrongly believe the US is in recession, and the majority blame the Biden administration. Go through it point by point. 55% believe the economy is shrinking. 56% think the US is experiencing recession. 49% believe the S&P 500 stock market index is down for the year. 49% believe that unemployment is at a 50-year high. Where's this coming from, and how does he change it?
Yeah, and I think the stock market numbers there are sort of the most enervating thing for the White House, just because, you know, that's not something where you have to read the headlines. You can look at your own portfolio and see that that's not the case. But I think that also shows what the real dynamic is here, which is that people feel bad about the economy, primarily because of inflation to date. Like, the price level remains dramatically higher than it was in 2019, regardless of rates. When you run focus groups, people say what they're looking for in terms of inflation being solved is for prices to come back down. But of course, no economist is sitting around waiting for the deflationary spiral to start. So I think, you know, you're getting negativity with that origin, and then people are expressing it on any economically related question that they're asked. Anything you ask them about the economy, their view is the economy is bad in a way that generally reflects inflation, and so any element of it that you ask me about, I'm going to say is bad. I don't think that dynamic is changing. I think that the economic strategy for the Biden campaign is going to be to run on a prospective contrast of vision and values and who's fighting for whom. Trump cut taxes for the rich in 2017. You know, Biden's fighting for the working class. Whether that'll work or not remains to be seen. But I think there's no way he's winning a sort of contrast of records. People are going to always remember 2019 as being a time that felt better than now, kind of regardless of what the current situation is between here and Election Day.
When you talk about partisan politics and people coming home, we saw that in the fundraising numbers that were just released. For the first time, Trump actually brought in more for the month, not in the entire war chest, but for the month than Biden. And Politico this morning has a story about how Biden is struggling to shore up grassroots fundraising. Where do you see this money game playing out? Because Trump is really starting to pick up some speed.
Yeah, I think it probably was inevitable that the gap narrowed. I do think that the Biden people are not going to suffer from some great shortage of money. Presidential campaigns, I think, are less dependent on money than any other campaign in American politics because you have an infinite quantity of earned media.
But you need millions of dollars.
Oh, sure. No, they need money, and but I think they both will be sort of swimming in money to first approximation. Like, it's if you're running a congressional campaign against an incumbent and you're trying to make people aware of who you are in the first instance, then it's like you're desperately in need of money and every dollar counts. For presidential campaigns, of course, like their finance operations are running full steam. They want every dollar they can get, but you know, it's a question of like your 1,000th campaign ad in a given swing state, like, and we're going to be blanketed in earned media about these guys. Like, I think that's the main thing most people are going to see all year is whatever they're doing through earned media.
How much do the legal troubles hinder Trump's not just war chest, but also his polling?
Yeah, I think it remains to be seen. You know, if you take people's the polling at face value, you know, Trump is sort of going to suffer a 7-ish point hit if he gets convicted of something, of a felony. People are notoriously bad at reporting how they are going to feel about something, like conditional upon a future event happening. So I'll take the under on that number. I do think it will weigh on him if he gets convicted. You know, there's, I think, again, a lot of people who are going to be unfavorable to both candidates. I think a lot of suburban college-educated moderates, which are sort of one of the battlegrounds demographically in this election, like, are not going to love the idea of a convicted felon as president, even if the set of felonies that he stands to be convicted of in this case are not quite as grave as the ones being alleged in other cases. You know, conversely, even if the jury hangs, I think that's a benefit for Trump. Like, I think that's not neutral. It's closer to an acquittal than a conviction, but we'll know soon.
Tobin, good to see you in person here in New York. Thank you, sir. Tobin Marcus there of Wolf Research. That poll was absolutely stunning. Just to go through some of the details again, 56% think the US is experiencing a recession, 49% believe the S&P 500 is down for the year, 49% believe that unemployment is at a 50-year high.
And you can't discount the way people feel. You could say maybe it's a perception issue, but we were just talking about how certain aspects of this recovery have been completely independent from the vast majority of the masses because it's been an NVIDIA story, it's been big tech story, it hasn't been a small company story.
Tobin nailed it. The views, the perceptions are colored by their experience with prices, and it's the price level, it's not inflation month over month, it's the last 5 years. Coming up shortly, dressed in green, Dan Ives of Wedbush on NVIDIA's guidance that, quote, should be hung in the Louvre. That stock is up by 7.5%. From New York, this is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Before I give you an update of the market, can we just take the shot? Just quickly. Just take the shot. Just quickly. My goodness. Sit tight, Dan. Stay close. Don't go anywhere. Good. Equity futures on the S&P look a little something like this. We're positive by 0.6%. On the NASDAQ, we're positive by 1 full percentage point. The lift off the back of a beat and a raise from NVIDIA. We'll get to that in a moment. In the bond market, 2-year, 10-year, 30-year. The scores look like this in the bond market. Yields just about unchanged on a 10-year, 4.4159. On a 2-year, 4. 86.46. Talked a lot about Europe and the data out of the Eurozone. Let's just sit on euro dollar just for a second. The euro shaping up as follows. 108.45. We're positive by 0.2%. I'll get to that data out of Europe in just a moment. Under surveillance this morning. Jobless claims due in just under an hour time. 220K is the median estimate in our survey. The weekly data expected to reaffirm the resilience of the labour market as the Fed speak. Bramwell goes into overdrive.
Yeah, and it really comes up with this conclusion that they're tilting more hawkish as the data continues to surprise, although it isn't continuing to surprise to the upside, which is sort of interesting. There seems to be a rethink on the Fed about what the neutral rate is, about what they have missed, what they have gotten wrong. So just based on the timeline, it's looking less and less likely to see a July rate cut, even though Andrew Hollenhorst will say absolutely nothing has changed and stop thinking like that.
What did you think of those minutes yesterday? I mean, I've got my own thoughts. You've got yours. I'd love yours first. Various officials also mentioned a willingness to raise rates if warranted. Many officials expressed uncertainty over the degree to which Fed policy is restraining the economy. What were your thoughts?
We've heard this from every single Fed official that's spoken. This is basically the rhetoric that we've been hearing. There is a question that Anne-Marie brought up, which is how much does Jay Powell represent the mainstream of the committee? What it highlights to me is there is an honest debate going on at the Federal Reserve. It seems like it's going to be hard to get consensus around something before September, and September is going to be a hard call considering some of the political implications.
Jobless claims about 60 minutes away. I promised you an update on European data. The recovery gaining a little bit of momentum here. Eurozone PMIs beating estimates and hitting their highest level in a year. Meanwhile, negotiated pay increasing in the first quarter from a year ago, posing an inflation warning just 2 weeks before the ECB is widely expected to begin cutting interest rates. Will they shrug that off and embrace the better data and say inflation's doing okay and we can cut interest rates? Based on what we've heard from President Lagarde, the answer is yes. Based on what we heard from PIMCO and Erin Brown just yesterday, they're very, very interested in getting more exposure to Europe because this growth policy mix is going to improve from here on out.
What incentive would the ECB have not to cut next month? Honestly, the market's saying go for it. They basically want to support the economy. All of a sudden, the soft landing is looking more in line for them than it was before, when people were talking about only the U.S., and the U.S. was an exceptional shot. Why wouldn't they say, great, we're going to cut rates, we're going to watch that, see how that goes, but I think we're good.
They have the confidence of the ECB that the Fed just doesn't have at the moment, seemingly. Let's talk about the number one story. Shares of NVIDIA soaring after the company reported yet another beat and raise. Dan Ives of Wedbush writing this. The godfather of AI delivered another masterpiece quarter and guidance that should be hung in the Louvre. Dan joins us now for more. Dan, good morning to you, sir.
Great to be here.
Masterpiece quarter. The bar was really high and they still beat it. What was impressive for you yesterday?
They should hang in the Louvre, because if you look at the guidance in terms of what we see on data center side, it was even, I think, $1 billion beyond whisper numbers. And if you look at the demand, this is the most important thing. Demand's accelerating. It's not even slowing down. So when we start to look and trajectory out, not just for NVIDIA, but second, third, fourth derivative, look, I don't know if there's popcorn machine, but I think it's time to get the popcorn out, because this AI revolution in 1995 moment, it's just starting.
Build on that and compare it to previous semis cycles. Chip makers go through cycles. Sometimes you hit an air pocket. Usually runways don't go on forever. What's different about this one?
It's really unlike anything we've ever seen in semis. And I think even, from a component perspective, you're seeing this across Asia, and we've seen it. They've never seen any demand like this, but there's only, right now, it's NVIDIA's world, everyone else paying rent. Now, you will have AMD and others, and the street will try to trajectory at who could, other sort of chip makers that are going to benefit. But this is significant for the likes of Nadella and Microsoft, Google, Meta. Then you look at names like ServiceNow, Oracle, Dell. So you're going to now start to see this tidal wave of spend. It shows it's going to be hitting the shores of tech. So that's why if you're a bear right now, they're going deep back into those caves, into hibernation mode with their valuation spreadsheets, because I think it's not being captured in terms of what we're seeing from a demand perspective.
You should be scared when bears go into hibernation. The gut check on markets, I think, are sometimes important to have. And maybe it's not about NVIDIA, because they've shown they are the only game in town. They own about 80% of the AI market. Is potentially some of the threat to the AMDs and the Intels of the world. You said it's NVIDIA's world. They have such a lead time in terms of the chips that people want, and they're now going into personal computers.
Yeah, I think Lisa Su and AMD, that's someone that you're going to bet on. I think in terms of what they're doing, that Intel, disaster epic proportions, and you see it in the stock. I mean, they are, right now, they're going 35 miles in the right lane. and NVIDIA and Jensen are in the Ferrari in the left lane going 100 miles an hour. So, but what this really does mean is it's the appetite. I think if you look at the demand from an enterprise perspective, and this is all the drum roll to June 10th, where Apple's going to release their AI strategy for consumers. And that's why this is a 1995 moment, not a 1999 moment.
I was looking at the profit margins of NVIDIA, something like 76%, which is sort of shocking, and the envy of certainly grocers and things that are looking at, 1-2% margin. At what point do you see the Googles of the world, the Microsofts of the world, push back and start to challenge pricing, start to create their own chips, start to say, really, we're paying a lot?
Yeah, look, the godfather of AI, Jensen, right now is really dictating that. Now, I think in a few years, you will see others, AMD, you're going to see Apple, Microsoft, they're going to look to build their own chips. But for the next 2 to 3 years, I mean, that is really something that's not feasible. They're going to have to continue to buy these chips. And that's why NVIDIA GPU chips right now, it's the new gold, the new oil when it comes to tech.
Intel market cap, $134 billion US. The stat doing around this morning, we're up in the pre-market for NVIDIA more than the market cap of Intel. What is everyone else getting wrong right now, particularly that company?
I think, what have they gotten right? I mean, it's a nightmare that just continues, really a horror show relative to what they could have gone after. They've almost been out. If you look, Apple's beat them at their own game.
Well, tell me, where did they go wrong, and why is it so difficult to turn around?
I think if you look from an innovation perspective, when you look how Jensen and NVIDIA bet on AI, Intel, I think, thought that was going to be a fad. And ultimately, that was something that was a miscalculation that they'll be paying for, really, for decades. And we could talk about U.S. and some of the things that they're doing from an innovation building, here.
Well, hold up. You think the winners now are going to potentially be the winners for decades? Because you remember the internet experience, it wasn't quite that way. There were some big winners at the time that ultimately ended up being big losers. You think it's sort of nailed down? These are the winners now for the next decade?
Look, I think it starts to go with, there's not too many typewriter companies that are still around. And when you look at Intel, they made some huge miscalculations. They're going to have to do M&A, and they're going to have to specifically accelerate this because NVIDIA and Jensen, that's the new age. I mean, they're where Apple was when they launched the iPhone. And when you look at Jensen, that's not someone you want to bet against, which speaks to, I think, when you even broaden this out, what it means for the rest of tech, for software, because now the baton's being handed to software. That's why you see McDermott, ServiceNow, look at Oracle, look at Dell. If someone told you 6 months ago that Dell was an AI play, they say, I don't really understand that perspective, but it just shows where we are, and I believe in the early stages of this new tech bull market playing out.
Intel's doing a lot, though, when it comes to investing. They just got $20 billion from the Chips and Science Act out of Washington. Besides M&A, what more do you think Intel should be doing?
I think that they got to focus on trying to beat NVIDIA, AMD in some components. They have the install base, they got the cash, but it's going to be about innovation. And I think that the problem with Intel is that it's been nightmare after nightmare, black eye after black eye in terms of going from an innovation perspective. And look, Gelsinger, I think, has the right strategy, but that and $3 gets you a cup of coffee if you don't execute.
Right. So when it comes to NVIDIA, back to NVIDIA, Intel, AMD, we had a recent report. I have to ask you about this because you're so bullish. We had a recent report about what this would mean if China were to invade Taiwan and how these companies could basically flip a switch because all of their chips mostly are being made in Taiwan. You wake up this morning and you see some pretty aggressive military moves around the Taiwan country in the strait because of the recent elections. When these kind of risks, how much do they weigh on you?
Look, I think it's right now contained risks. As someone that's been to Taiwan a number of times. Now, that if you said what could spoil the party, it's not the Fed, it's not demand. China continues to be the biggest risk here, and from a geopolitical perspective. And that's why I think right now, if you said probably the biggest concern is geopolitically what's going to happen there. But if you look at that balancing act between U.S. and China in this cold tech war, they're right now able to balance it, where you also have a huge AI story that's happening in China. And at the end of the day, no one wants to hear it. U.S. needs China, China needs U.S. Because building chips here in the U.S., replacing the Asia supply chain, it's a better chance of me playing for the Rangers this week.
Okay, which is exactly where I was going to go. You don't seem to have a lot of confidence in Pat Gelsinger and his ability to actually recreate some sort of foundry in the United States. Is that what you're saying, that you think a lot of the money that's gone into this and the federal subsidies won't necessarily create the behemoth and the high-tech chip supply that a lot of people are talking about?
I mean, it could dent it a little, and you could start to move some to the U.S., and you're starting to see that. But the reality is, for the next 3, 5, 10 years, that supply chain is going to be in Asia. And as I say, look, if you like $2,500 iPhones, we should make them in New Jersey. If you like $1,000 iPhones, then they continue being made in Foxconn. And I think that's the issue here in terms of this balancing act, despite what we hear from the 202 area code.
So based on all of this, how long before NVIDIA is a $3 trillion company?
Look, I think we are going to get there a lot sooner than everyone expects. And I think when we talk about $3 trillion for NVIDIA, that's something that will be on the horizon. And now we're going to start to be looking at, we're going to be talking about $4 trillion and $5 trillion when we look out over the next 2, 3, 4 years in terms of where we see tech going. And I think that's what's starting to play out right now. This is an AI gold rush, and it's being led by the Godfather.
Rangers, Panthers, who gets it done?
I think tough loss. I do think Rangers get it in Game 6.
What happens to the Knicks?
Look, I think just ultimately they, too tired, injuries.
Too many games, right?
Look, but I do believe Knicks next year, just like, I think what we're going to see this year, I think Rangers could potentially be a Stanley Cup.
A renaissance of New York sports. That's what we all want.
It's 1994. Look, it's 1995 in tech, 1994 in New York sports.
It's like Patrick Ewing's back.
Yeah.
It's like Formula One, just like everything we're seeing here.
Love it. Dan Ives, thank you, sir. Dan Ives of Wedbush.
Thank you.
Appreciate it, mate. Thank you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. China held its biggest military drills in a year around Taiwan. Anne-Marie mentioned this, the exercise coming just days after Taiwan's new president took office. Chinese state media saying that the drills are meant to, quote, serve as a strong punishment for the separatist acts of Taiwan independence. Taiwan deployed sea, air, and ground forces in response and condemned China's actions, saying they undermine regional stability. JP Morgan is looking to buy a private credit firm to add to its $3.6 trillion asset management arm. That, according to people familiar with the matter. Earlier this year, the bank held talks to buy Monroe Capital, but a deal was never reached. JP Morgan has already earmarked $10 billion for direct lending, as a private credit industry has exploded in recent years. At Atlanta, snap Bayer Leverkusen's 51-game unbeaten run to win football's Europa League. Fresh off winning their first ever German league title, Leverkusen were favorites for the match, but the Italian side spoiled their perfect season, winning 3-0 to claim their first major European trophy. And that's your Bloomberg Brief. John.
Danny, thank you. Shout out Steve Paliuca, owner of the Boston Celtics, also owner of Atalanta, for an amazing win for that company, for that club. Just absolutely phenomenal. Spoke to Steve this morning. He's going to try and join us next week. Hasn't slept all night. He's on his way back for the Celtics game.
I can just
Isn't
imagine.
that amazing? What a life.
He has such a good life, and he goes to a lot of the games. He's not one of those owners that just sort of like checks in. I wonder if the guy over at Oak Tree is going to take.
He was on the pitch last night celebrating. Don't know if you saw him on the TV.
He was
on the pitch
partying.
celebrating, holding the trophy.
Right
Very
there
cool.
in the middle.
Very, very cool. More on that, I hope, next week. Up next on the program, Fed officials holding the line.
I think the Fed is going to hold the line on that and make sure that we're coming back to 2% on a sustained sort of basis. But things can downshift here pretty quickly as we go forward.
That conversation up next.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg.
Equities near session highs, positive here by close to 0.7% on the S&P 500. Yields just about unchanged, 441.59. I feel like I owe you every single segment an update on NVIDIA, and here it is, Bramo, up by 7%.
Which, as you pointed out, is about $170 billion of market capitalization on this $2.3 trillion stock, which raises this question of, yes, it is bigger than Intel, but how far can it go? With Dan Ives talking about $4 trillion, $5 trillion. I don't know.
At some point it ends, everything does, but not after that quarter, not after that. Under surveillance this morning, Fed officials holding the line.
I think you will see continued slowing as we go forward. Now, certainly not looking for a rate cut anytime soon. I think the Fed is going to hold the line on that and make sure that we're coming back to 2% on a sustained sort of basis. But things can downshift here pretty quickly as we go forward.
So here's the latest. The yield curve shifting to its flattest in more than a month following hawkish Fed minutes. Ashok Bhatia of Neuberger Berman writing this: we continue to favour the short and intermediate parts of the yield curve in anticipation of declining cash rates, but remain cautious on longer dated bonds on debt sustainability concerns. Ashok joins us now for more. Ashok, good to catch up with you. So it has been way too long. Let's split up the curve and go from the short end to the long end and start at the longer end of the curve. What are these debt sustainability concerns? Are they in corporates? Are they in sovereigns?
They're in sovereigns, and good to catch up too with you all. It's really, corporate balance sheets, even household balance sheets are largely in good shape here. Debt levels in the corporate sector are not at historical lows, but they're certainly in sort of the lower percentiles for where they've been historically. But the flip side has been the buildup of government debt. And it's not just the U.S., it's European countries as well. Obviously, the Japanese fiscal situation is well known. And particularly for the U.S., this is a period where this government debt is no longer going to be bought by the Fed. It's no longer going to be bought by the Chinese to the same level. And foreign investors like the Japanese are really struggling with hedge costs. And so we look at the world over the next couple of years, and the clearing price for some of this long-term debt we think is likely to creep higher as we have to attract more private sectors and domestic investors back into the government bond markets.
So I've always tried to keep it really simple, and I've always said the test between a DM and an EM sovereign issuer is ultimately how they perform at an economic downturn. And in economic downturns, you know what happens with treasuries? They bid, they rally, yields drop. How do you think they'll perform in the next downturn, given the concerns you have?
Well, I think you'll see performance from short and intermediate rates. So, let's just imagine we get a big slowdown, a recession. The Fed's rate's 5 3/8 right now. They'll probably take it down at least 200 basis points in that type of environment. So you can get that performance from short and intermediate rates. But in a world where policy rates maybe settle around 3%, 3.5%, a 10-year note where it currently is at 4.5 or so, that's not terribly unreasonable. So I think this next downturn, and this is sort of kind of ties into why we're emphasizing these short and intermediate maturities, is that's where you'll get the hedge benefits, the correlation benefits, and the performance in a significant downturn. And I think it is just a lot more uncertain how long-term rates will perform in that type of world going forward.
What do you think the clearing price will be if we continue to run 6 to 7% budget deficits to GDP in America? What kind of extra yield are you talking about to compensate investors?
I think, it is going to depend a lot upon, what the Fed ends up doing. And do we run these deficits in a world where growth is strong or growth is weak? If let's, say we get this slowdown and automatic stabilizers kick in and we're in a big slowdown, that clearing price can be maybe for long-term rates at these levels or a little lower. But if we are going into a world where growth is going to be, stick around these levels, at the same time fiscal policy remains pretty loose, that clearing level, could be, 5%, maybe a little bit above that. And I think that really just speaks to, one of the big debates that's coming in the bond market, started last year, it's going to be with us for a while, is where's the right clearing level for long-term rates? And there's just a lot of things that go into it. The last 15 years, we've been in a world knowing where the clearing rate was going to be because the Fed would buy these bonds and we had plenty of foreign demand in zero and negative yields. And this is all in a lot of flux right now.
At the same time, a lot of people have pushed back on this argument and basically said we don't see that. Typically, when there is some sort of economic downturn, people do go into longer dated treasuries. And what's the alternative? Not necessarily in U.S. markets, but internationally. Why wouldn't international buyers come back to treasuries ultimately? Because even though the deficit's not great in the U.S., it's not looking so much better in a lot of the other developed markets.
No, that's a fair point. I think the answer to that is it's a lot tied to hedge costs, particularly for the U.S. I mean, the U.S., we obviously run a current account deficit, so we need foreign buyers. And one of the challenges is if you just take the Japanese have a steep yield curve, we have a flat yield curve, and our policy rates are a lot higher. So don't dispute at all. If we get a big significant slowdown recession, could you see a little bit of performance from long-term bonds? Maybe a little bit. But I think, it's going to be hard for foreign investors to really embrace our markets right now with how their yield curves look to ours. And, the big change, I think on this point of how it will look going forward is, we're probably going to be in a positive, real yield environment given the end of QE for a while. And that limits the amount of downside you can get in yields compared to a lot of the last 15 years, we think.
I love it. You're a bond guy and you like stocks, and that's your basically investment pick right now. That's basically the argument that you're making.
Yeah. I guess we're all watching NVIDIA.
A lot of people. I guess that's really the way to go. These are some of the comments that you were making that I thought were fascinating, that 90% of the inflation fight is already done, and who cares about 3 to 4% inflation? It's going to be just fine, and stocks tend to do better in that kind of environment. To me, this is really the key. You think that the Fed is not actually sensitive to inflation. You think that they are employment sensitive and that they're going to respond to that and allow inflation to remain at these levels, which will be supportive of stocks. Am I characterizing that right?
I think the general point that, will the Fed, throw the economy into a significant slowdown or recession to get the last mile of inflation out of the system, probably quite unlikely. And I think that we have to remember, right, the Fed has a dual mandate, employment and inflation. For the last, 2 years or so, it's been, they could just, focus on the inflation mandate and employment was going to be fine. It's still, the labor market is in really good shape. We'll see how that develops. But we think we're on a track to, mid-3 core inflation by year end, maybe a little bit lower. And we think we're on a track to mid-2 inflation by, 18 months from now, maybe a little shorter. So the Fed's on the right path. And, will they try to squeeze 2.5 down to 2? Probably that debate will come, but our guess is not. And, it is an environment where, if the Fed and other central banks are able to stick a soft landing, like we've communicated or written, that doesn't have to be a terrible and can be a good environment for equities and other asset classes too.
Ashok, I'm going to think out loud for the next 40 seconds, which is sometimes dangerous, so forgive me. I want to go back over what we've been talking about. So quite clearly, we've transferred risk away from household balance sheets to sovereign balance sheets, which is the point you're making. Corporations have turned out their debt as well. You're saying that debt sustainability concerns on the sovereign are the key issue here, not on the corporate balance sheet, and that yields could be higher than they otherwise would be. Where would that leave spreads? Can you just help me understand how different things might be right now regarding spreads in an economic downturn and the current state of things as well, how things sort of shape up there?
Yeah, well, spreads, if we look at just sort of index levels, IG spreads at the index level are around 80 basis points. High yield is around 300 in the U.S. Really, in the post-financial, crisis world, the lowest high yield spreads have gone to be a little bit below 275. So not quite at the lows, but we're within pretty close distance. And I think the world where there's more government debt and decent corporate fundamentals, big picture level, that should result in tighter equilibrium spreads than we've maybe been used to. I think the defaults we think will remain low. Our main message on the credit markets, there's really two. One is that expect spreads to remain sort of tighter end of ranges. Fundamentals will support that. But one of the big changes has been with the rise in yields. Markets that we haven't really been able to participate in, securitized markets, mortgages, suddenly offer attractive yields, and there's just a lot more to do.
I could talk to you all day.
Sorry.
It's good to catch up.
Okay.
Ashok Valia of Neuberger Berman. Thank you, sir. Appreciate it. Coming up next, Sebastian Page of T. Rowe Price.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less-known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
we think we're going to see is softer inflation and softer activity in labor markets.
Potential earliest you would see a rate cut, and depends on what's happening with the data between now and then, would be in September.
You're going to probably see about half of those cuts than what the Fed is currently anticipating.
The risk right now is that they either hold out and cut too much too quickly and kind of overstimulate things and then have to kind of reverse course.
You're going to get probably an unsustainable boom in 2025, and I think the Fed's going to have to start raising.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It has been at least 5 minutes since we've quoted NVIDIA, so let's do that right now. The price is up by 7% in the pre-market. We're talking about $130, $140 billion of market cap added to a $2 trillion name, which is just absolutely outstanding. We'll get the breakdown again of the numbers, a review, some analysis for you through the next 60 minutes or so. But a standout quote for me, Lisa, and I've read this a few times, came from Joseph Moore over at Morgan Stanley. Bottom line, we think the backdrop warrants AI exposure, even amid extreme enthusiasm. NVIDIA remains the clearest way to get that exposure. If you want to ride this wave, how else do you do it, apart from this name right here?
A lot of people have tried to be cute about it. They've gone into utilities. They've gone into other sectors that could benefit. I think that what this shows is when people are worried about valuation, NVIDIA just shows them you just have not priced in how much we can actually capitalize on this. And I think that the biggest takeaway on a larger scale is how much does valuation matter at a complete sea change in a certain technology?
Goldman Sachs this morning upping their price target, 1,100 to 1,200 when it comes to this name, given the blowout report. I love what Dan Ives said there. It's NVIDIA's world. Everyone is paying rent. The godfather of AI in his Ferrari, and he sees the trajectory going to $4, even $5 trillion for this company.
Dressed in green, came in the studio with shades on. I've never seen him so cool, so relaxed. I know some people might be watching thinking, that's the top, that there, right now, green jacket, glasses. I could have said that last year and the year before, again, repeatedly, on some of these stories.
Well, check out his outfits just generally. I mean, they've always been pretty bright. So if you want to take a, this is the top, you could have done it from last year or the year before. You're right. People are still underpricing even after shifting the bar so much higher. Again, this just comes to this question of how divorced is this from the rest of the economy versus the trickle down that people have been expecting in terms of productivity gains. That, I think, is the bigger question that's really indeterminate.
What did he say? Told the bears to get their valuation spreadsheets and go back to their caves. It's pretty punchy
like
stuff,
deep back in their caves, not back in your
Seriously,
cave.
punchy stuff. Equities right now on the S&P 500, the scores look like this. We're positive by 0.7%. In the bond market, shaping up as follows. Yields not lower by even a basis point. We're just about unchanged. 441.98, and in foreign exchange, the euro 108.52. We're positive by 1/3%. A stronger euro, some better data. As Lisa mentioned earlier, manufacturing picking up just a little bit again over in the Eurozone. Coming up this hour, we'll catch up with Sebastian Page at T. Rowe Price on what he calls his boring market outlook. Mandeep Singh of Bloomberg Intelligence as NVIDIA delivers on AI hopes, and Dana Peterson of the Conference Board on why she sees 2 rate cuts to end the year. We begin with the big issue, NVIDIA's upbeat earnings pulling stocks even higher. Sebastian Page at T. Rowe Price saying this: the bulls have done well because they are focused on earnings. Companies are flush with cash and spending on AI. This is not the tech bubble. Large cap tech is printing cash. Sebastian Page is with us around the table. Seb, it's good to see you. It always is. Good morning.
Likewise.
Enthusiastically neutral, boring's good. Was anything about last night boring?
Not at all. And my colleague, Dom Rizzo, runs a tech fund, and he likes grand statements. And you had a lot of grand statements last night.
Sure.
But he said that AI is going to be the greatest productivity boom for humanity since electricity. So I'm not sure how on board I am with that level of grandeur in the statement, but this is real. And if you think about it, we just talked about valuation on NVIDIA. The price-earnings ratio is down, right? Because just earnings have just gone up so fast. As an asset allocator, I don't think I've ever been so interested in stocks. 2.3 trillion market cap.
It's incredible.
The market cap of the Russell 2, John, is 3 trillion. And you just heard Dan Ives said NVIDIA is going to 3 trillion. Microsoft is over 3 trillion. So those markets are very concentrated. So we like growth stocks. We actually have a tilt, a small overweight right now towards value stocks.
Why?
Look, the valuation case is compelling. Now, I'm not ready to take my spreadsheet and go back in my cage, my cave, like the bears. I'm just going to say that you're in the bottom quartile of valuation for value stocks relative to growth. Now, that's been a trap historically because it's gotten cheaper and cheaper and cheaper. But if you look at that bottom quartile, the outperformance of value over growth over the next 12 months historically is about 5%. Okay, so there's a valuation case. Then you ask, what are the catalysts? I do think geopolitical risks adds some risk of an oil spike. You have stickier inflation, stickier interest rates. So you potentially have macro catalysts. And one more, going back to AI, we think over time, I guess Dan and I have called it the tidal wave of AI spending. This is going to come to stodgier, older style companies as well in terms of productivity gains. And that doesn't look priced in at all.
But John alluded to this, that basically the best way to play AI right now, it seemed like, was through NVIDIA, through the AI giant, the godfather of AI, not through all these ancillary bets of sort of the trickle down into the older economy and utilities and everything else. Why not just be overweight the basic play on artificial intelligence if you believe it's going to be the biggest thing since sliced bread?
But that's definitely what has worked over the last 12 months. I do think that the effect of AI on value stock, and this is not a pound the table, I think you should own growth stocks, look for opportunities to add to value stocks. But if you look at earnings and the broadening of earnings, let alone the broadening of market returns, just earnings, by the end of this year, year over year, for the fourth quarter, the expectation is that value stocks will outgrow, in terms of earnings, growth stocks. Now, granted, this is because the comparables are really, really easy for value stocks. But you do have a passing of the baton. We like to be contrarian. It's not always comfortable. You look back and you say, okay, being long NVIDIA has worked. And again, we like growth stocks. But I think what's not priced in right now is that tidal wave that Dan Ives talked about.
Meanwhile, you say you like to be boring. You say that you like to be aggressively and happily, very enthusiastically neutral. But you said as an asset allocator, you have never been more interested in stocks. So why not overweight stocks at a time where you see a sticky inflation and you do see such a rosy backdrop?
Look, you have an economic slowdown. I don't think it's a recession, but a slowdown. And you do have some long and variable lags. And this is very controversial because the effects have been sort of a rolling recession. But you do have a fair amount of tightening in the economy that hasn't come through because everyone's refinanced on long-term debt. So that is coming through. So the bears on my asset allocation committee are looking at that, looking at the slowing economy, and yes, ultimately looking at top-level valuation, 21 on the S&P 500 versus 16 historically, and kind of just being cautious. We've just had a huge rally, and we kind of just, and again, my point with being boring, and we've talked about this last time I was on the show, is strategic asset allocation.
Which we don't talk about much, so please do.
You have a strategic asset allocation as an investor. Why not stick to it? You think about your risk tolerance, how much stocks you should own, sort of in general over time. That's what I'm saying. I'm not saying get out of stocks. I'm saying stick to what kind of risk tolerance you have in your asset mix. We look a lot at life cycle models, Jonathan. Is how far are you from retirement? And how much stocks should you own? The whole 60-40 debate, people kind of lose the idea that if you're like 15, 20 years from retirement, which I am, it's not 60-40. According to life cycle models, it's 80% stocks. So all I'm saying is don't be a hero. Don't just pedal to the metal on risk. Don't panic and get out of stocks. Think about your strategic asset allocation. It's boring, but I think that's the kind of market environment where you have to do that.
Can we talk about this current market environment with regards to bonds? We just spoke to a guest, Ashok Bhatia of Neuberger Berman, who made the point that he didn't like longer-dated sovereign debt here because he was worried about fiscal sustainability concerns, and that potentially in the next economic downturn, those bonds wouldn't be bid in quite the same way, that maybe even yields would have to stay at elevated levels. What were your thoughts when you heard that?
Yeah, I saw that. He was talking about 5%. And look, if you ask me what's the scariest chart in all of capital markets right now, it's government debt service cost. It looks vertical. And that is worrisome. What does that lead to when, Lisa, you made the point earlier, like there is Tina's back, there is no alternative to U.S. Treasuries in a big market downturn, in a crash. And that's still there. But I'm sympathetic to that idea. If I look out 12 months, we're still short duration. We have cash and an overweight cash, and at the same time an overweight credit because we don't expect a recession, but we're net short duration. So I'm really sympathetic to that idea. It's really hard to actually know how this will play out. Because look, you can have spending cuts. Doesn't look an election year. Are we really going to get that, Anne-Marie? You can have you can have higher inflation. That's another way to kind of get rid of that debt problem, and I think that's quite possible. You can have higher taxes. So I think that debt service payments are due to continue to rise. Hard to think about how this is going to get resolved. Or you can have just bond vigilantes like you had in the UK, where the bond market just said, "That's it. We're not going to buy this auction." I know you like auctions, Lisa.
Thanks.
You're catering to everyone.
To this point, Sebastian, though, you say when you're looking at the market, be boring. This is anything but a boring year when it comes to the politics. How are you thinking about the election when you look at your market and your asset allocation?
Yeah, and this is coming into focus right now. And look, it's a really close one. Again, it's a kind of a 50-50 country. And I do think that you do have differences in terms of tariffs. I do think that with a Republican win, you would have higher tariffs. Depends if you get a split Congress or not. But overall, Anne-Marie, fiscal, pedal to the metal. I think that's what we're looking at for now.
Do you agree with Adam Posen that whoever wins, there's going to be a fiscal boom, there's going to be some sort of inflationary boom, one way or another? This can be enacted just simply with whether it's tariffs or a different immigration policy. That would increase the chance of a Fed rate hike next year. Do you agree with that?
Yeah, and I agree if you say that the consensus is that the chances is zero, right? So increase the chances from what to what? It does, on the margin, from maybe what the market is seeing right now as close to zero to 5–10% chance of a hike. Yeah, absolutely. Combine that with a commodity shock, which is always kind of doesn't matter until it really does, and it happens really fast. Now you have an inflation problem. You might be running, we're running at 4.5% Q1. You might be running 5.5. I'm not saying 9, but combine that with the commodity shock, and yeah, we'll be glad we're short duration.
Where did that come from, commodity shock? Is there something you're concerned about, something you're focused on?
Yes, in the sense that if you look at the Strait of Hormuz, where everyone thinks, okay, it's okay. This is a 40% of oil flow traffic through the Strait of Hormuz. So that kind of disruption, and I'm not a geopolitical expert. I talked to some, and it's hard to, again, predict how that would happen, but there have been tensions around the Strait of Hormuz in the past. And if you block oil flow right there, boom, you're off. Low probability, but it's always possible.
Are you positioning for that low probability, and if so, how?
So we're long real asset equities. So this is back to the inflation theme. This includes energy companies. It includes also real estate, which is a much longer-term inflation hedge, doesn't behave the same as energy stocks. So it's a diversified portfolio, as well as metals and mining. So talk about copper rallying on AI. So metals and mining as well. Diversified portfolio. We're long that asset class.
Interesting. Always love catching up with you. Thank you, sir.
Likewise. Thank you.
Talking tactical asset allocation, which we often don't do here, so thank you. That stung when he said that. I'm never going to let that go. That's sort of cut real deep.
Yeah.
When was that? A month ago?
And we've talked extensively about it every day.
I'm still bleeding
in the
from
breaks.
that wound.
Really?
We don't talk about tactical asset allocation.
I'm just thinking about my retirement.
You want to retire?
Number of years, yeah.
How many years?
Wow.
What should Anne-Marie be in?
I think Anne-Marie should be 90% stocks.
90% stocks?
Yes.
Okay, we'll sort that out. Sebastian Page at T. Rowe Price, thank you, sir. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Xiaomi has raised its sales target for its marquee model, an EV that it hopes can one day compete with Tesla. The Chinese smartphone maker is accelerating its push into EVs, and at the same time reported its fastest pace of revenue growth in more than 2 years. Xiaomi now expects to deliver 120,000 of its SU7 model, having received close to 90,000 orders as of April. Nikki Haley says she plans to vote for Donald Trump, but stopped short of an outright endorsement. Haley, who challenged the former president for the Republican nomination, is the latest Trump critic to back his White House bid. She was speaking publicly for the first time since dropping out of the presidential primary, saying, quote, "Biden has been a catastrophe, so I will be voting for Trump." And Taylor Swift is giving Europe's economy a boost, a story that continues to play out, according to new data from Bank of America. Swiss Paris Conference helped to lift consumer spending in the city by 22%. The bank added that other European cities can look forward to a similar boost. Upcoming tour stops include Madrid, London, and Milan. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the Morning Calls, plus Mandeep Singh of Bloomberg Intelligence recapping numbers from NVIDIA. That's next. This is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly. We're Monzo. Give us a go.
See? I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Business in a span of 7 to 8 years. It tells you a lot about, how well they have executed, and it is a virtual monopoly at this point of time. I mean, even though we talk about AMD and other competitors, they're nowhere close to, how quickly this company is shipping product and how they're able to raise prices. I think what really stands out here is the ASP increases that they continue to show from Ampere to, Hopper and now Blackwell. They're adding more kind of capabilities, networking and other kind of things, and they're charging more to the customer, and they're happily paying it. So that's the most impressive part about what they're doing.
They're adding an Intel Plus this morning to the market cap, which is absolutely phenomenal for a company, as you say, that did not exist as recently as when? 2015. That's ridiculous. This is what Morgan Stanley said. We've gone back to this quite a few times. This name is the clearest way to get AI exposure. Is there nothing else? Is this it?
I mean, this is table stakes. And that's why, you know, when they called out last night that Tesla is a big buyer along with the hyperscalers and the sovereigns, Jensen named countries like France, Italy, all buying NVIDIA chips to build their own GPT equivalent large language model, it tells you something that, you know, there is an arms race and this is the only game in town in terms of giving you that functionality. But when it comes to valuation, that's where you have to ask yourself, what is the normalized level of earnings for this company? I mean, clearly, you know, they are blowing through their numbers. Triple-digit growth is phenomenal. But stocks look at perpetuity. And in the long run, are they over-earning now? Because we have seen instances of, you know, companies during the pandemic. They grew triple-digit, Zoom and a lot of other e-commerce names. And then what happened afterwards? So there's always a normalization, and that's what you got to fear of as an investor. Will the competitors catch up? Probably not. But the law of large numbers will come into play, and at that scale, it's very hard to keep growing, you know, 25, 30%.
And this raises also the issue of how long can they keep having a 76% profit margin on their sales? At what point do the Microsofts and the Metas push back and say, really, guys, you're going to raise this some more? Which really raises the question. So far, this has been a feature, not a bug, that the big four that really comprise the bulk of their business account for about 40% of their sales. When does that become a headwind, given the fact that they're trying to develop their own chip makers and they're trying to diversify, maybe eventually push back?
Yeah, and that's where I think they called out China last night. So they said China market is getting competitive. I mean, I understand the restrictions aspect of it, but why is it getting competitive? Yes, they don't have their latest end chip in the market, but the fact that it's getting competitive tells you that, you know, there are players out there that are developing the stack in a way where they can train a large language model without NVIDIA chips. And that is the biggest risk for NVIDIA because the one other data point they gave around the inferencing side, inferencing is 40%. That wasn't an uptick. I mean, we are so used to NVIDIA gaining share or, you know, doing better than the previous quarter. Well, guess what? On the inferencing side, it was the same number, 40%, and we don't know the details around what comprises that 40%. If all these companies are launching their new AI PCs or if Apple comes up with a new smartphone, that's all inferencing. So I think that's the risk that NVIDIA has is on the inferencing side, they don't have as much exposure and there are more players. Training side, they are a monopoly, and I think they will remain a monopoly. It's just there will be a digestion period when it comes to training these large language models, and maybe GPT-5 needs more chips to train, but how often are you going to train those models and how large are those models going to get? And if it's going to be in a straight line, that's the question that you have to grapple with here.
Yesterday they said, quote, we are racing, this obvious insatiable demand we are seeing. Can you put in context how much demand is outstripping supply?
Well, it clearly is the case for both their architectures. So right now they are shipping Hopper architecture, and they talk about H100s being in short supply, but not to the extent that H200. And that's, I mean, I'm using a lot of their chip names because that's how fast they're shipping. Like when you look at traditional CPU cycles, it used to be 2-year architecture. NVIDIA has really fast-tracked that. They are shipping new architectures every year. And if you're a company that's buying NVIDIA chips, you have to ask yourself, how often do you buy and how much do you have to depreciate? So what will happen is hyperscalers spending $35, $40 billion, they have to depreciate that expense. They used to do that over 4 to 5 years. Now if they're replacing it every year, they have to depreciate it much faster. And that's going to show up in the income statement as a depreciation expense. So clearly that's the risk they run into is, I mean, ultimately, if you're shipping faster, it's going to add up to the depreciation expense of your buyers.
Mandeep, super thoughtful stuff as always. Mandeep Singh there of Bloomberg Intelligence. Mandeep, thank you. That name is up by anywhere between 6 and 7% through most of this morning. In just a moment, for the space of about 10 minutes, we won't talk about NVIDIA. We'll be talking about this. Jobless claims in America. The estimate is 220,000. The previous week was 222. Andrew Hollenhorst of Citi has thoughts. Andrew always has thoughts. Good morning, Andrew. He's looking for a rate cut in July, even after those FOMC minutes yesterday, which sounded pretty hawkish on the margin. He says data dependent And in his note this morning, it goes on to say, Fed officials are emphasizing higher for longer policy rates, but further weakening in labor markets or softer inflation would provoke a series of Fed rate cuts, and we expect those trends to emerge in upcoming data. This is not a multi-quarter call. He's talking about this happening in the next couple of months, so we'll see.
Ashok Bhatia actually would not necessarily disagree in the direction of travel in terms of where the Fed is. He said Fed pretends to be inflation sensitive, but is actually employment sensitive. And that seems to be what Andrew Hollenhorst is saying as well.
Breaking jobless claims just around the corner. Reaction from Dana Peterson of the Conference Board. We'll catch up with Matt Dizok of Maryland Bank of America Private Bank. They'll be here to break this down. Michael McKee on the other side as well. Lots to talk about. Equity futures near session highs. We're positive by 0.75% on the S&P 500 with a record high in sight. The opening bell about an hour away from New York. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities positive here by 0.75% on the S&P 500. On the Nasdaq, up by more than 1 full percentage point. The opening bell about 16 minutes away. Around the open, no doubt, we'll be talking about all-time highs, and Nvidia up by another 7%. Right now, we need to talk about the economic data. Mike McKee's around the table. Jobless claims due in about 8 seconds' time. This is what we're looking for. 220 is the estimate. 222 is the previous number. With the data, here's Mike. Good morning, Mike.
Good morning. Well, let's see what we get when the DOL downloads the numbers. 215,000 down from the 222 initially reported last week. So we're back to the same sort of range that we were before. Now, of course, when you talk to Fed officials, and oddly enough, I've been doing that for the last 3 days, they're not particularly worried about the labor market right now. What they're watching is inflation. So as long as these numbers stay contained, the Fed's going to be happy. But it does show that the economy is still strong enough to keep the labor market in place, and that means they're not in any hurry to cut rates. The continuing claims number, 1,794,000, and that is down from 1,786,000. That's the revision from the week before. The revision to last week's initial claims, 223, so no real change there from 222. So all in all, the labor market still seems to be about where it was.
Mike McKee, off the back of this, yields pick up just the tiniest amount. We're just about unchanged on a 2-year at 486.68. Equity futures, session highs going into the print. Session highs right now up by 0.75%. But I do think this data is important, Mike. It was only a few weeks ago we broke out into, what was it, 230s, 232? Something like that on jobless claims. And the question was being asked, was this the beginning of it? And I remember you said at the time, be careful. We've seen this before in the last 6 months, the last 9 months, and we've come all the way back down towards 200K. Is that what we're doing again?
Yeah, the jump 2 weeks ago was basically because New York State allows the school employees who are not teachers to file for unemployment claims when they have vacations, and they had the spring break, so everybody filed, and that pushed the numbers up. Happens every year about this time, and now we're back down again. So it doesn't suggest, at this point, the numbers don't suggest that there's any real deterioration. Now, you talk to the Fed folks that I was talking to down at the Atlanta Fed conference, and they're basically saying that what CEOs are telling them is they're not really hiring so much anymore. So it'll be really interesting to see what happens with the payrolls report. But they're not getting rid of people either, because there's enough business that they need everybody they can get. And of course, they went through the scarring effects post-pandemic of trying to find people.
You know, Mike, you have just been spending a couple of days speaking with Fed officials. Do they have a dashboard of indicators of economic data points of which actually are the most reliable and how they're shifting? Whether basically they have, you know, this one count a little bit more. Today we'll count JOLTS a little bit more because it's going to matter a little bit more. Today, unemployment claims. I mean, how do we understand at what point this is a reliable metric that's really going to move the dial?
Well, I don't think there's any one metric that's going to move the dial. They did mention in the minutes yesterday that they are looking at services price, non-housing wages and inflation, and try to see if that goes down. That's a big contributor. They're watching goods price inflation because it started to go up again and now is looks like some disinflation. But one of the things they talked about was at the conference was the fact that they're following all kinds of data these days, and a lot of it is not the government data. They're looking at the private sector data on prices and on employment, and they're just trying to make sense of it all. And no one number is what they're relying on. They're trying to get a comprehensive trend.
Mike, also in the meeting minutes yesterday, we saw that many participants are questioning the restrictiveness that the Fed has on the economy. We haven't really heard that, though, from Jay Powell. What's your sense when you're speaking to them behind closed doors at these kind of conferences?
Well, they're looking at what's going on in the economy, and they can see a restrictive impact on things like housing and auto prices and credit cards, obviously, but it's not affecting Wall Street, and Wall Street keeps going up and up, so the financial conditions indexes start getting looser. It's sort of circular. Wall Street goes up, conditions go down, and Wall Street goes up again. But that does impart something of a wealth effect into the economy that they're trying to keep an eye on, and they're not seeing Americans slow down spending all that much. We saw weaker retail sales this last month, but that may be a seasonal effect because of Easter. We'll have to see what happens in the next report. But if Americans keep spending, even though they're not buying houses or cars, it tells you that maybe they're not restrictive enough. So they're watching that.
Mike, I'd love to talk about some of these misconceptions with you. We had this Harris poll conducted exclusively for The Guardian, released in the last 24 hours.
Yeah.
These numbers, Mike, are absolutely incredible. And if you're just tuning in, welcome to the program. I'll share them with you as well. 56% think the US is experiencing a recession. 49% believe the S&P 500 is down for the year. We're looking at all-time highs in about an hour from now. 49% believe that unemployment is at a 50-year high. Even with jobless claims at 215 and unemployment under 4%, where's it all coming from?
Well, it's something that political scientists in particular are trying to figure out, because the Fed earlier this week released their 2023 consumer attitudes, and 72% of people said they're doing just fine, thank you very much. So everybody sees the problem as somebody else's, but they do see the problem as somebody else's, that there is a problem in the national economy. The Fed in the minutes talks about the fact that they think that people understand what they are doing and they just need to do more of it, keep talking about it. But obviously for the political people, this is a problem. That people are not seeing what's really happening out there.
We'll come back to those numbers in just a moment. 6 minutes ago, we got jobless claims. They came in at 215,000. The estimate was 220. The previous week, around 220-something. We've been coming down, though, over the last couple of weeks, and that's important. Equity futures stay elevated, up by 0.75% on the S&P. That record high is in sight and just around a corner, potentially in about an hour's time. On the Nasdaq 100, up another 1.2%. This lift coming off the back of developments with NVIDIA. In the bond market, yields just about unchanged at the front end of the curve. The scores in fixed income look like this. The 2-year 487.10, a 10-year 441.39. Mike mentioned payrolls next week, or a few Fridays away, Bramo. A few Fridays away, and looking for 203K in our survey at the moment. That's the median estimate against the 175 from the previous month. Now, the reason I bring up those estimates is because the likes of Hollenhorst over at Citi, they're looking for weakness. You don't see it in claims, and you don't see it there in that estimate for payrolls in 2 weeks' time.
He's saying about 150,000 would be enough to get the Fed to move. And this, to me, is compelling at a time where maybe, as Mike said, CEOs aren't hiring, but they're not doing mass firings right now, at least not based on these initial jobless claims.
Let's get to the panel. Joining us now is Dana Peterson of the Conference Board, alongside Matt Dizok of Merrill and Bank of America Private Bank. Dana, can I come to you first, please, and just get your response to jobless claims? The scare of a few weeks ago, is it over?
Well, we don't really know, but the thing is, jobless claims are still extremely low. And as Lisa said, many companies are not letting their people go. They're holding on to their workers, they're hoarding them. And so we're probably not going to see much uptick in the unemployment rate going forward. Companies need them, and also they're facing lots of people retiring. So I don't really see the labor market weakening significantly over the next year.
Matt, to bring you into the conversation, do you share those thoughts? Do you have that constructive view a year out?
We do share those thoughts on the employment market. Corporate health looks very good right now. At the end of the day, that's what's going to drive the employment market. How are companies feeling? How are they doing? So we do feel very good about that. We're not too concerned about it. But the idea that rate hikes don't work, the idea that it won't slow the economy somewhat, we'd be a little skeptical in those kind of arguments that we're hearing.
Well, okay, just taking a step back, you were the one, and I think I misattributed this earlier, saying that the Fed pretends to be inflation sensitive but is actually employment sensitive. You say rate hikes work. It might just take a lot longer. Does that preclude the idea of a rate cut if they're employment sensitive and inflation is still too high?
So we do believe, our baseline forecast is we will get one rate cut this year, probably in December. But to your point, it will take time to see these rate hikes work their way through the economy. General monetary policy lags like a year to 2 years. 10-year just peaked in October, November of last year. It's about 6 months ago. Fed funds rate just peaked about 9 months ago. So we're not even in that 12 to 24-month window. Come back to us in early, mid, late 2025 to see these rate hikes work. So we do think we're starting to see some of that now. Uptick in credit card delinquencies, uptick in auto delinquencies, some slowdown in consumer spending, retailers that are reporting earnings, seeing a little shift in mix, and lower income guys pulling back a little bit. So we are starting to see those effects. We believe we give it time, we'll get there.
So Dana, can you weigh in on just sort of the odd discrepancy right now between what Matt was talking about, the slowdown, between the data that shows that jobless claims are not picking up and the fact that people feel really bad? I mean, do you have a sense of whether it will take actually getting laid off for them to stop spending entirely, for that to actually crack the market in a more material way? Or do you think that this steady softening will eventually just bring us down to that soft landing nirvana?
Well, consumers have mixed feelings. For the most part, they're happy that they're working right now, but they are still very upset about inflation. And certainly when they look out 6 months from now, they have concerns about their incomes, employment prospects, and also business prospects. And so that's why we've seen some weakening in our consumer confidence measure. But when it comes to spending, we are seeing consumers pull back. Certainly they're not buying homes, and once the Fed raised interest rates and mortgage rates shot up, the housing market responded almost immediately. We also saw that businesses stopped investing because the cost of capital was rising. And we see that consumers are pulling back on goods, and our consumer confidence survey suggests that they will continue to pull back on those big ticket items. The big question now is services. Can they continue to spend on services? And the thing is that right now, consumers have run out of that excess savings. So a lot of the trips and things that they're going on, the services they're consuming, they're putting it on credit cards. And we know that interest rates are very high for credit cards, and the debt service is rising. So I think that this is all part of the plan, and that we will continue to see consumer spending slow, and that we'll probably have a bit of a soft patch this year. But as long as consumers are continuing to work, I think the Fed can continue to focus on inflation.
Dana, how well aligned is consumer confidence with CEO business confidence at the moment?
Well, CEOs are, I would say, cautiously optimistic. For about a year and a half, they were very negative. And then in the last 2 quarters, it ticked up above our 50 threshold in terms of optimism. But still, businesses are saying, look, we're not having trouble finding qualified workers. We're not laying people off. We're just holding on to people. But we're not looking to invest much. And the thing is that we are still facing high costs from labor because they intend to continue to raise wages to hold on to their people. But still, they're very concerned about a number of risks, especially the implications of the elections coming up, and also a number of geopolitical issues. So I'd say CEOs are not as gloomy as they were last year, but they're still very cautious.
Matt, this is what we're trying to figure out, how the dominoes fall from here. We can identify this week that some of these retailers have lost pricing power. That's clear. The CEOs are talking about it. What we're trying to understand is what happens next. How do they protect margins? Do they pull back on costs? What can they do? Do they lay people off? To Dana's point, do they hoard, given the experience coming out of the pandemic? What do you think the ultimate outcome will be?
We do think labor hoarding is probably going to continue. And again, when we think about this in a larger context, this is not pessimistic news. This is good news. This is what we want to see. We need to slow the economy somewhat to continue to bring inflation down. But the big picture, inflation was 9%. It's now down to 3.5%. Core PCE is already below 3%. We don't have to worry that much about getting down to that exact on the screws 2% PCE number. We're in a much better place right now. If you look historically at equity market returns, it doesn't matter whether you're 0 to 2% inflation or 2 to 4%. You do just as well in nominal, just as well in real. This is a good news. What the Fed is doing will eventually work. They can keep rates about this level, maybe trim a little bit end of the year. And if they do that, we could have that mid-90s setup where everyone thought a recession was happening. It didn't happen. Credit spreads stayed tight for a while. Equity is absolutely ripped for the rest of that decade. So the slowdown we're seeing is optimistic, warranted, what we want to see and what the Fed's trying to encourage.
So it sounds like you agree with Dana that this is just a soft patch, not going to be softer for longer. But to John's point, if these companies are having to cut costs, you don't think at any point that will mean letting off employees?
Oh, no, I absolutely do believe at some point, if it continues on this trajectory, that's exactly what you see. But that is what you expect to see. So it's always a question of when that starts to happen, what does the Fed do? As Ashok had said earlier, I believe it was, and we completely agree, pretends to be super inflation sensitive. Now that 80 to 90% of the inflation fight is done, they're not. They're employment sensitive. So when they start to see that more, which we're not yet, but we will, then they'll adjust tack. Then hopefully they cut in December. Then they'll cut next year, fine tune, keep the economic expansion going.
Dana, let's build on that. How does that influence your Fed call for this year?
Well, we have the Fed cutting twice this year, probably at November, December meetings. But I have to disagree a little bit. I think the Fed is still very inflation sensitive. and they're probably a little less labor market sensitive. Why? Because they'll be okay if the unemployment rate rises a little bit. We have it topping out at 4.2%. That's extremely low. Most people who want to work will work. But the problem is that everyone experiences inflation, and they do want to get key inflation gauges back sustainably to the 2% target. Sustainability is important. They don't want to just touch it and then move off of it. And the thing is that they have to do that because of credibility purposes. They say their target is 2%. They want to get it there.
Matt, do you have a response?
So as we think about the inflation numbers, and again, they're going to officially keep their target 2%. We believe that. But, and you have to be a math major for this one, if you let inflation go to 9% and never let it go below 2, you're probably not going to average 2%. So they've already de facto kind of faded that inflation target a little bit. Again, we don't find that to be a tremendous problem. 9%, 7%, 8% inflation, problem. 2 to 3.5% inflation, not a problem for nominal GDP, not a problem. And meanwhile, fixed income valuations are so much better now. The 10-year was around 3% when CPI was running at 9%. Now we've got the 10-year about 4.5% and CPI PC below it. These are good valuations for fixed income investors.
We'll get to the bond market in just a moment. You say not a problem. Why did Governor Waller give last month's read a C+, if it's not a problem?
To be fair, we're trying to be optimistic here. I'm the bond guy. I'm trying to be positive. There are problems within the inflation data, particularly as we've all talked about on the services side. And right now we're getting goods deflation or almost no inflation, about 0%. But you can't have an average inflation number of 0% goods and 4% services. And we are seeing an uptick in services. So there are definitely areas that they need to focus on and watch. And the fight's not done. But again, they're much closer to done than they have been. And some fine tuning hopefully gets them there.
Dana, I want to pick up on something that you said. You think that this Fed is particularly inflation sensitive and less employment sensitive at a time where potentially, we were speaking with Adam Posen of the Peterson Institute yesterday. He was talking about how a policy shift come December or January of next year could single-handedly mean an increase in tariffs or potentially a change in the immigration policy. And frankly, the extra immigration, a lot of people are arguing, has put a downward pressure on inflation that otherwise would be in the system. Do you think that given potential inflationary policies, that would actually put the Fed in a really awkward position with a labor market seeing the weakness that you're expecting while also seeing inflation remain sticky or even inflect upward?
We're already seeing inflationary pressures from policy. Certainly industrial policies and the trade wars that we experienced back in 2018, 2019 that are still going on, those are all placing upward pressure on inflation. And so the Fed this is the new norm. The Fed is going to have to operate in the world that it's in. And as it sees policies or consumer behavior or external events like climate events that are pushing up insurance costs, whatever it is, the Fed is going to have to deal with that within the bounds of its mandates, right? And so I think that, for this year, the Fed probably will see that slowing in inflation that it wants to see. It'll feel comfortable cutting rates 1, maybe 2 times this year. But next year's another story. And they're probably going to have to take a more gradual approach to cutting interest rates next year. And I think where rates will land will be higher than what we saw during the period between the Great Financial Crisis and the pandemic, both in nominal and real terms. I think that's the new reality. Inflation pressures, upward inflation pressures, are the new reality that the Fed is going to have to resist day in and day out.
Which, Matt, really points to this reason why maybe people are so optimistic about equities right now, because that environment is supportive of equity valuations if inflation's actually allowing them to increase profitability and some of their revenues. As an investor, as chief investment officer, do you say it is a safer bet to go with equities at this point than certainly duration, given that type of backdrop?
We actually don't. We actually have a slightly different view there. We do like equity risk here, to be fair. We are slightly overweight equities. Again, 2, 3, 4, even 5% inflation. Again, if you can grow your sales at that level without selling more goods or services, your earnings will do fine. Great for equities. We do want to take a little more macro risk in the portfolio, so we are slightly overweight equities. At the same time, if we look at the valuation picture on fixed income, you can easily build a diversified investment-grade portfolio today of over 5%. You haven't seen that in 20 years. More importantly, in real rate terms, 2 to 2.5% real. If we were talking January 2021, it was negative 2%. right? For the privilege of giving your government $100, you could get $80 of purchasing power back in 10 years. Thanks for that. Now you can give them $100 and get $120 back in 10 years. So again, that actually gets a bond guy excited. I know maybe like, 5% yields, if you hold it for a whole year, you can get half the return of a particular tech stock pre-market, but for a bond folk, that's actually interesting. And we have to build portfolios for, right? Joking around a little bit, but we have to provide portfolios for is what happens we don't expect. And we do expect that treasuries, investor-grade corporates, agency mortgage-backs, they will provide diversification. Maybe a little bit in terms of price if rates come down, but more importantly, by steady, reliable, predictable income year in and year out, that's how they will diversify portfolios. So we're actually slightly long duration at the moment.
Doesn't take much to make you happy after the previous decade with rates so low and negative. Matt, it's good to see you.
Good to see you, John.
Been too long. Thank you, sir. Matt Deasok there of Merrill and Bank of America Private Bank alongside Dana Peterson of the Conference Board. Mike McKee still with us. 215, Mike, then, against an estimate of 220. Final word on this one.
Well, a couple of quick points. One is that the Fed wants to see, as Matt was saying, wants to see a slowing economy. They expect to see a slowing economy. They won't cut rates because we go to 150 on jobs, but they might if inflation keeps falling, because then real rates go up. But the other thing is they won't get to 2% before they start cutting rates. They'll cut rates before they get to 2%, which may mean we don't get to 2% because it may get sticky at 2.3, but then both sides will be more or less happy for the time being.
Mike, thank you. Equity futures positive. Near session highs up 0.75% on the S&P 500. Going into the opening bell with some stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Wall Street firms are phasing out work from home, and FINRA wants you to know that it is not their fault. An official at the regulatory authority said on Wednesday that there's no rule requiring employees to come into the office 5 days a week. In fact, the new slate of FINRA rules that will take effect soon is meant to preserve workplace flexibility. The statement was in response to announcements from firms, especially Barclays, that are weighing return to office mandates 5 days a week. Now to a Bloomberg scoop. The Justice Department and a group of states say that they will sue Live Nation for antitrust violations. Shares down about 6% in the pre-market trade. Regulators are looking to force a breakup and address Ticketmaster's unrivaled control of concert ticket sales. The merger was originally approved by the Obama administration in 2010, but the Biden administration opened a probe in 2022 over concerns the company was violating its original terms. That issue came to a head when Ticketmaster fumbled the massive demand for Taylor Swift's Eras Tour. Harvard University's governing board has decided not to award degrees to 13 students who participated in a probe. The board made the decision despite a vote by 115 faculty to allow the students to graduate, even though they violated the university's policy, according to the Harvard Crimson. The students will be able to participate in the commencement ceremonies, but will not receive diplomas. More than 1,500 Harvard students will receive degrees today. And that is your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Up next on the program, setting you up for the day ahead, the short road, going into a long weekend. From New York, this is Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Live from New York City, counting you down to the opening bell. Here's the trading diary for the day ahead. US PMI data coming up at 9:45 Eastern Time. Atlanta Fed President Raphael Bostic speaking at 3 p.m. Eastern tomorrow morning. We'll get durable goods and new consumer sentiment. And the Treasury market closing early, of course, at 2 p.m. ahead of the Memorial Day weekend. To wrap up the market morning so far, I think Dan Ives at Wedbush does it perfectly. Take a listen to this.
If you look at the demand, this is the most important thing. Demand's accelerating. It's not even slowing down. So when we start to look and trajectory out, not just for NVIDIA, but second, third, fourth derivative, look, I don't know if there's popcorn machine, but I think it's time to get the popcorn out because this AI revolution in 1995 moment, it's just starting. Right now, it's NVIDIA's world, everyone else paying rent.
Lisa, NVIDIA up 7%.
To me, that's the theme of the day. NVIDIA launching in 1995 all over again, boom in stocks and basically the optimism. And at what point can people basically say, this is the safety play at a time when other things are kind of raising some flags?
I love that quote. NVIDIA's world, we're all living in it. Everyone else is paying rent, and the rent may get more expensive. You see these price targets that keep lifting on this company. And what Dan Ives is talking about, a $4 or $5 trillion stock.
Look out for record highs at the opening bell in about 34 minutes time. Coming up tomorrow, here's the lineup for you. Lee Ferridge of State Street, TPW's Jay Pulaski, Terry Wiseman of Macquarie, and Nationwide's Kathy Bosjancic. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The top names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
For our viewers worldwide from New York City, I'm Matt Miller. NVIDIA knocks the cover off the ball, and that is driving futures this morning. The countdown to the open starts right now. Coming up, futures pointing to another record high on blowout NVIDIA results. The AI darling delivering yet another beat and raise quarter. And on the eco front, jobless claims posting their biggest back-to-back decline since September. But we begin with the biggest issue, NVIDIA to the rescue.
This should hang in the loop. If you look at the demand, this is the most important thing. Demand's accelerating. It's not even slowing down. So when we start to look and trajectory out, not just for NVIDIA, but second, third, fourth derivative, I think it's time to get the popcorn out, because this AI revolution in 1995 moment, it's just starting.
Joining us to discuss, Keith Lerner of Truist and Jeremy Zurin of UBS. I don't know, where else I could possibly start besides NVIDIA. Keith, what did you make of the earnings and the trajectory going forward?
Yeah, well, great to be with you. I think the markets, or the reaction speaks for itself. I mean, the results were really good, and you already had high expectations going into this report. They delivered, and they really reconfirmed where we've been overweight tech and remain overweight after this. If you think about the technology sector as a whole, it typically outperforms the overall market when earnings momentum is stronger than the overall market. And the NVIDIA report just confirms that. And I think we're going to see continued follow through in the tech sector, along with semiconductors more broadly. And it keeps us overweight equities.
What do you think, Jeremy? I mean, is this enough to drive the whole market higher?
Well, look, the earnings momentum has been driving the market higher for sure, and this is likely to just add one more quiver to to the arrows of the bulls that say that the earnings momentum can continue, because tech is such a big part of the overall market, and AI is such a big part of the tech narrative. I think that the concern that I have is just about sustainability of the relative earnings gap that we're seeing with technology and everything else in the market. And so while everything is great for tech today, I think when you start to look forward, 2, 3, 4 quarters, I'm still expecting a broadening out of market returns and, away from, not necessarily to the detriment of tech, but I think that the rest of the market can play a little bit of catch up in terms of narrowing that earnings gap, where, you'll see, non-tech sectors start to post better earnings in the second half of this year, and tech earnings will still be fine, but they may decelerate given very difficult comparables towards the second half of this year.
I want to get to that broadening out in just a minute, but right now let's get over to our Bloomberg Intelligence analyst who focuses specifically on tech companies, including NVIDIA. Mandeep Singh joins us now from BI. So Mandeep, what stood out to you? I mean, there was a beat, there was a raise, the exponential growth has been incredible to watch, and what do you make of it?
I mean, the fact that they said their new architecture, Blackwell, will contribute to revenue this year, I think it's phenomenal to see that level of execution where you come up with 2 architectures in a year and you actually generate revenue out of shipping those. So clearly the execution has been off the charts, and they are capitalizing on this insatiable demand. I mean, the market is still supply constrained. They talked about lead times coming down for their H100, but for the new stuff that they're shipping, it's still supply constrained, and that's why you see that ASP growth. I mean, the fact that NVIDIA has 78% gross margin, this is unheard of for any semiconductor company. And I think as long as they can sustain the pricing power, that gross margin, that feeds into the EPS growth, and that's why the shares are reacting positively.
Yeah, I noticed Cameron Kreis on the MLive blog today was talking about how earnings per share were $3 and change a couple of years ago, and now we're looking at $26 if you factor in the splits, right? He also says, comparing them to Cisco in 2000, at the peak of the dot-com earnings, Cisco had a trailing PE of 118 for the fiscal year 2000. That sort of multiple on NVIDIA would represent a pre-split price of more than $3,000 a share should current fiscal year EPS forecasts prove accurate. Now, he goes on, Mandeep, to say, okay, that valuation was crazy with Cisco then, and obviously it came crashing down. But how much higher do you think NVIDIA shares could go from here? They're trading at almost $1,000.
Well, so that's where, as an investor, you have to think about the normalized levels of earnings and the fact that, you know, they're coming off of a year where they had top-line growth of triple-digit. Obviously, at this scale, it's not sustainable. Still, the consensus expects them to do very well, you know, north of 40% for next year. So clearly, the expectations are that they keep gaining market share, and we know the data center market has expanded because of this big AI CapEx wave. So as long as they can hold a virtual monopoly position, the multiples can sustain. But the moment there is a whiff of a slowdown in terms of the growth rates, that's when you will see multiples correct. But we're not there yet.
Well, the pop today in the share price is expected to create over $170 billion of new market cap, which is more than the entirety of Intel. So, you know, there was a time when Intel dwarfed NVIDIA, and now the latter is lapping the former. Take a look at the SPLC function on the Bloomberg terminal, because I think this supply chain screen that we have tells a lot of the story. You'll see the suppliers on the left, only about 100, more than 700 customers on the right, but we know that the top 4 make up really the biggest buyers, almost half. And it's just a pretty amazing function that I highly recommend people with a Bloomberg terminal check out. We have breaking news right now from Morgan Stanley. So I'm going to break away from NVIDIA and go to Morgan Stanley's ticker. It looks like James Gorman is going to step down as the CEO, as the chairman, I should say, at the end of the year. So in case you're keeping up with what's going on in the big bank chairs, James Gorman is going to cede his role as the Morgan Stanley chairman at year end. This caps nearly a 2-decade run, of course, at the firm. He came in and rescued it from the brink of failure and then turned it into really a wealth management powerhouse, and has done very well with his succession plans as well. So James Gorman, 65, is going to step down as Morgan Stanley chairman by the end of the year. We'll continue to bring you details on this story, though it was fairly well telegraphed. He did name Chief Executive Officer Ted Pick to take that post eventually. So no replacement named immediately, but James Gorman is stepping down. Let's get back to Mandeep Singh from Bloomberg Intelligence just quickly and touch on one last point with NVIDIA, Mandeep, and that is, you know, they have a lot of customers, 700 on the SPLC function and only 107 suppliers there. But I think the suppliers may grow to a bigger part of the story as they make more than just chips. They make full computer systems now, and I think that was one of my most interesting takeaways from yesterday.
Yeah, in fact, they broke down their networking revenue, and the fact that they're giving you a cooling solution now as part of the new Blackwell series. I mean, that's why the ASPs keep going up. So clearly, I think customers are buying into their architecture, and when you add the software layer to it, the CUDA layer, that's what gives it the stickiness, and you know, the fact that customers are spending so much money in terms of buying NVIDIA chips and all the new architectures that they are shipping.
All right, Mandeep, thanks very much. I'm sure you'll be on television, Bloomberg Television and Radio, for the entirety of today talking about just this. I want to get back to our investors. Keith Lerner, Truist Advisory co-CIO and Chief Market Strategist, as well as Jeremy Zarin, UBS Asset Management Head of Private Client U.S. Equities. And Jeremy, you were talking about the broadening out, and I wonder how much you can use suppliers and customers of this behemoth to map a portfolio going forward. Because if AI really is the start of an industrial revolution, those have to be a lot of the players that you want.
I think that's right. So I think that in any type of technology paradigm, what you typically see is that you have an initial pop in the names that are the picks and shovels and the enablers of the technology. But then as it evolves and as more use cases start to become apparent and in the marketplace, the market starts to try to identify, really the AI adopters. And what's unclear today is, are we in the fourth or fifth or eighth or ninth inning of the run in the stocks in the AI enablers? But I think that ultimately we will see that transition. And I think a lot of software as a service companies that will produce, and own lots of proprietary data that can be fed into large language models that will provide services that will increase revenues, like a Microsoft, will be, the next wave of gains in the markets for AI related to AI. And I also think that there's lots we don't know, right? There are lots of applications, lots of new companies that will be unearthed over time that will take advantage of this new, transformational technology.
Yeah, super microcomputer, for example, is one I hadn't really heard of until the stock exploded. Keith, what do you think about this new opportunity? I mean, obviously, we've been focused on AI pretty closely since at least last year, but how important is this going to be as part of your clients' portfolios going forward?
Well, it's really important for many reasons, not only from a sector level, but when you think about it globally, tech is a much bigger part of the U.S. markets relative to, say, developed international. So tech is about 30% of the S&P 500. And you look at something like the EFI or the developed international, that's around 9%. You look at large caps versus small caps, tech is a much larger weighting. So it's important. You have to have a view of tech. And our view is still constructive. And at this point of the AI cycle, we still think this is early cycle as far as what we're going to see as far as productivity gains. But we're really sticking with the bigger mega cap names at this point because it costs money to develop, to enable AI. And we're seeing a lot of the benefits near term. We expect at least over the next year to accrue to some of these bigger mega cap companies. And if that's the case, even though I agree with some of the comments earlier, we're going to see somewhat of a slowdown from this really, these rapid growth rates. But I still think that you have a secular story that even if the economy slows down somewhat, if we have more cross currents, the election, that businesses are going to continue to have to invest in tech, otherwise fear of being left behind. And as a result of that, these Mag 7 type of names should continue to benefit. And as you alluded to earlier, NVIDIA, again, I'm not recommending individual securities, but it's trading after this still closer to a 30 multiple. And as you go downscale some of these, like you think about the Metas and Alphabets of the world, relative to their growth rates, they still seem pretty reasonable as well. So we just still think there's overall upside in the space. And that also tells us to stay with the U.S. and be focused on the large cap area as well.
All right, I want to talk about that regional planning and, of course, the economy and the election as well with you guys. Keith Lerner of Truist and Jeremy Zirin of UBS are going to stick with us. Right now, though, let's get a look at some of the other individual stocks moving ahead of the opening bell. For that, we go to Bloomberg's Simone Foxman. Simone?
Yeah, well, we have to start off, Matt, with shares of NVIDIA, which in the pre-market are trading above that $1,000 per share historic marker. Shares there up close to 7% after the CEO heralding the beginning of a new industrial revolution and earnings just outsized. One thing we haven't mentioned so far this morning, the 10-for-1 stock split, really potential to juice retail demand. All the analysts really positive on this. Morgan Stanley, for example, talking about how the backdrop warrants AI exposure even amid extreme enthusiasm. On that AI front, we're seeing gains in shares of Snowflake as well. This is a cloud-based analytics software company. It beat on its revenue in the first quarter when it reported earnings yesterday and raised targets for the second quarter and the year on strong consumer interest in its AI-oriented products. So AI again. One name, however, that is down in pre-market trading is Live Nation. It was a Bloomberg scoop. The Department of Justice and a group of states plan to sue Live Nation for antitrust violations. This really has to do with Ticketmaster's unrivaled control of concert ticket sales. That is a lawsuit that is likely to be filed today, Matt.
All right, Simone, thanks very much for that. Bloomberg Simone Foxman going through some of the individual movers, but of course, only NVIDIA matters, or at least it seems that way. Of course, we have a lot more moving parts, economic data to talk about with the jobless claims, and the breaking news on Morgan Stanley. James Gorman is going to step down as the chairman of Morgan Stanley at the end of the year. We'll talk more about that when we come back. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology. This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Let's get back to the breaking news out of Morgan Stanley. James Gorman will step down as the bank's chairman at the end of the year. Remember, he already passed on the CEO title to Ted Pick, and it's been thought for a while that Ted Pick will eventually take over as chairman as well, but we don't know who the exact replacement will be for now. Joining us with more is Bloomberg News finance reporter Sridhar Natarajan. So, Sri, what do we know about Gorman's plan? He's already kind of laid out a great succession path after turning the bank around.
Right, he's been very methodical about how he will be giving up his duties starting May 2023, when he did talk about the idea that he will be eventually giving up his title as the CEO of the firm. He then said that he will stay on for a little while to help with the succession, to help with the transition, and then give up his chairman title as well. Well, today, he formally announced that he will be stepping down as chair of Morgan Stanley at the end of this year. This is a significant moment in time. This is a man who jumped to Morgan Stanley fairly late in his career. He only joined Morgan Stanley in 2006 to help rejuvenate their wealth management business. But soon after, the financial crisis hit, and Morgan Stanley was in a world of trouble. So when James Gorman rose to the title of CEO back in 2010, Morgan Stanley was fending off serious questions about its ability to survive. Not only did he bring back the firm from the brink of failure, he helped transform it into a wealth management powerhouse. You could argue that James Gorman effectively bought low, sold high. And now the challenge for Ted Pick, his successor in the CEO role and most likely as chairman down the road, will be to prove that he can still drive this growth story forward, that there is more gains out there for Morgan Stanley for investors to embrace.
Is it likely that we get a different successor as chairman for now, Sri? Since obviously Ted has to be focusing on his new job, is it likely that we get, say, a 1-year interim or 2-year interim chairman before Ted can take over both titles as the most successful Wall Street CEOs are wont to do?
That will be a big story if that were to happen. We do not expect that to happen at JP Morgan. Jamie Dimon is CEO and chair. At Goldman Sachs, David Solomon is CEO and chair. And Morgan Stanley, which would consider itself as a part of that trio among the elite of US banking, you don't expect that CEO and chair role to be split. So if Ted Pick were not to rise into that seat, were not to step into that seat, it would indicate not everything's hunky-dory at Morgan Stanley, and we're not expecting that.
Although, I have to say, Sri, when I was a kid, it was widely considered bad corporate governance to have the CEO also be the chairman of the board. Is that no longer the case, or is Wall Street just an outlier?
And look, you're not alone. There are a lot of shareholders who still make that push. They want the CEO and chair role to be separated. In fact, at JP Morgan's shareholder meeting, there were 42% of people who said, more than 42% who said that the CEO and chair role should be separated. That is for Jamie Dimon, one of the longest serving US banking leaders. Despite that, the convention, at least in US banking, has been if the bank is doing well and the bank is in good shape, you normally expect the CEO and chair role to be held by the same person. Corporate governance push, a revival on that front, might change that down the road, but the convention right now is for the same individual in both seats.
Got it. Sri, thanks very much for stepping in here on this breaking news. Bloomberg Sridhar Natarajan covers the banks for us. And, of course, we're going to continue to talk about this throughout the day. Keith Lerner, Truist Advisory co-CEO, and Jeremy Zurin, UBS Asset Management, Head of Private Client, U.S. Equities, still with us. And, you know, Jeremy, let me just start with you on the banks broadly. I know you guys aren't going to be recommending individual stocks, but what do you think of the big Wall Street banks? They seem to be in very good shape right now, and if rates stay higher for longer, maybe that means better net interest income.
Yeah, I think that the broadening out theme that we talked about a little earlier, the banks are front and center. So I think the problem the market has had with the broadening out theme over the past few months is that tech earnings and growth stock earnings have been surging while the earnings base for everything else has been flattish. I think the catalyst for this broadening out ultimately will be disinflationary trends starting to reassert themselves, interest rates starting to come down a bit on the long end of the curve, and the Federal Reserve cutting interest rates, short-term interest rates in the second half of the year. If that transpires, then I think that financials are in very good shape to be a beneficiary of this broadening out.
I mean, I was in Germany for 6 years covering banks there, moaning about low interest rates, 0 or negative. Are they now really that concerned about high interest rates, Jeremy? Do they really need a cut?
Well, it's more about just the economic activity and stimulus that low interest rates would have for the more cyclical sectors of the economy, right? One of the reasons we have this big earnings gap between secular growth and cyclical growth is because high interest rates are stunting cyclical growth. And so if we start to see greater confidence that the Federal Reserve is going to start to embark on a easing cycle, I think that can start to unleash some capex from companies, and that can improve loan growth and limit credit risk for the financial sector and allow for valuations to expand as well.
It's interesting. Torsten Slok from Apollo was talking about higher supercore inflation. It's trending higher right now because we have hospital services and auto insurance really driving that up. The housing market is stuck, Keith, and so a lot of people are hoping the Fed will cut rates to drive that kind of economic activity and anything else that's demand-driven, right? What do you expect the Fed to do? It's in a tough position.
Yeah, I mean, we're actually now more in line with the market. We think 1 or 2 rate cuts is still more likely, and that's last year when the market was pricing in 6 to 7, we really thought it was probably going to be 2 or 3. So now maybe we've adjusted slightly down. But I think from a market perspective, the positive is this: is if the economy stays somewhat resilient, which it has been, then that should be positive for earnings. Even if inflation stays a little bit higher, that should be good for nominal profits. And if the economy slows down, I think you have, in some ways, a little bit of a put from the Fed. Now, the risk would be if they go the other way and they raise rates. We don't think that's likely. The Fed's pushed against that. I think we've had some chatter from the minutes that there were some people still talking about that. But outside, if we look at the last week or two, look at retail. Walmart's CEO said for the first time in several years, they've seen where year over year there haven't been increases. It's been flat. Then you're seeing like Target cut prices as well. I think the auto insurance premiums that have skyrocketed aren't likely to move at that pace going forward. And the big debate, which we still will likely think will come down, is rents. So rents are still staying sticky relative to a public market data today as well. So we still think some of those disinflationary trends likely will continue, but probably at still a kind of a volatile pace down.
All right, great to get some time with you guys. Thanks for joining us. Keith Lerner there at Truist Advisory. He's the co-CIO and the chief market strategist there. Jeremy Zirin is head of private client U.S. equities over at UBS Asset Management. Thanks so much for joining us. Coming up, the morning calls, and then later, Matt Miskin of John Hancock joins us around the opening bell as stocks head for yet another new record high after NVIDIA's blowout results. This is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Time now for our morning calls. First up, Oppenheimer downgrading Under Armour to a market perform, pointing to weakening demand trends there. Next up, JP Morgan upgrading Hasbro to overweight, saying the company is positioned for impressive toys growth. And finally, Argus upgrading Wynn Resorts to a buy, highlighting the rapid recovery in Macau. Coming up, the opening bow with John Hancock's Matt Miskin. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or what, how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
This is the countdown to the open. I'm Matt Miller, moments away from the start of trading, where we'll likely see, I believe, a 25th record high on the S&P 500 after the blowout earnings we had from AI chip maker NVIDIA. Of course, that's the main stock that we want to watch at the market open, so we're going to get to that in a second with a host of reporters. Right now, let's take a look at some of the other assets moving in today's trade. Euro, I'm going to guess at 108. Yes, 108.60. The 10-year yield at 442, and NYMEX crude up 1% to $78.42. Now, NVIDIA had blowout earnings after the bell yesterday. The chip maker shattering expectations with earnings showing artificial intelligence, at least for now, is a huge growth engine. Ed Ludlow joins us with more from Bloomberg Tech. He's over on the West Coast. So Ed, I mean, where do you want to start? The revenue beat expectations. The earnings are, I think, 8 times what they were 2 years ago, and the shares just continue to rocket higher.
It's a pretty good summary. I mean, let's start with the outlook for the fiscal second quarter. You know, it's just a number at the end of the day, but revenue will be $28 billion plus or minus 2%, which is pretty comfortably above expectations. In fact, it absolutely shatters expectations. But the story's becoming more clear that NVIDIA is starting to sell the current generation H100 GPU and has a pipeline of demand for the next gen H200 in the future Blackwell beyond just the hyperscalers. That was very much the narrative, that consumer technology, enterprise, government customers are now going to start showing meaningful revenue. And so the AI story or the growth story is sustained. And then they told you everything that you kind of wanted to hear. They are supply constrained. In other words, demand outpaces supply. Blackwell, which is the combination GPU, CPU, the next gen AI accelerator, ships starting this quarter, ramps next quarter, and actually goes into data centers in the fiscal fourth. That's probably quicker than the market had anticipated. And, you know, I'm paraphrasing, but Jensen Huang basically said, we will see lots of revenue from Blackwell this year. And that probably took some by surprise.
You know, Tom Keene used to have a jargon alert on surveillance, and it would have gone off a number of times there, Ed. Hyperscalers, just to start with, is something that I don't think everybody out here knows what that is. If you go back, though, to old-fashioned math, I have a viewer writing in saying that post-split, each point move in NVIDIA stock is going to add about $25 billion in market cap. So almost the revenue for the quarter. Each penny is going to add $250 million in market cap. This stock is just an absolute behemoth.
First of all, I really appreciate your point on the hyperscalers and the jargon. One thing I would say, I've learned a hard lesson in the last 12 months. that on the sell side and buy side, you have a lot of desks that are really going into granular detail to understand what's happening with NVIDIA. But we were basically talking about the cloud providers building massive data centers, and that's where all the GPUs or the chips were going. Now they're going to smaller scale enterprises, you know, on-prem, basically servers that sit in your office. And that's interesting. On the stock split, all you need to do, go to Reddit, go to X, Google Trends in real time. NVIDIA was top yesterday during earnings. And what's so interesting about this is the divvy was kind of like an interesting thing. It's a bump from 4 cents a share to 10 cents a share on a $1,000 stock. But on the stock split, it lowers the barrier to entry for retail investors who are also like micro-focused on the AI story. I wonder how that does trading. But in the future, what if growth slows? Then we start to think about cash flow. And I think that if you were cynical or skeptical about the sort of investor-friendly policies that were announced last night, you go back to cash flow and try and do the math of how NVIDIA can continue to justify its valuation. Those are kind of the conversations I had last night.
All right, Ed, great to get some time with you. We look forward to your program. Ed Ludlow, host of Bloomberg Tech, kicks off at 11 a.m. East Coast time. 8 a.m. on the West Coast. Turning now to entertainment, the Justice Department is seeking to break up Live Nation and Ticketmaster, according to people familiar with the matter. Simone Foxman has more on this. Is it fair to say monopoly? Can we say? I guess unrivaled is the right way to say it.
Unrivaled control of concert ticket market. There's been some discussion this morning about whether it's a monopoly or a monopsony, but one thing seems clear that the DOJ and states will file this suit today in the Southern District of New York. They're going to go after the exclusive ticketing contracts with concert venues, the dominance that Live Nation and Ticketmaster really exert over concert tours and venue management. They're going to allege, we understand, that this has raised the fees, has raised prices for consumers, has eliminated innovation in the industry, and of course has limited competition. Interestingly, the Obama administration let this merger of Live Nation and Ticketmaster go through back in 2010. The Trump administration imposed a settlement, had an external monitor come in because there were concerns about some of this antitrust behavior. This suit, however, ultimately seeks as one of the potential penalties a breakup of these two companies, but analysts not thinking that this may actually be successful. Jefferies, for example, talking about the high hurdle for breaking up this company, and even if they do, you're left with two dominant industry leaders. But Bloomberg Intelligence points out this is negative sentiment. This is going to be an overhang for the company in the near term. We await, of course, those details of this suit, Matt.
I mean, have you bought a concert or sporting event ticket from anyone other than Ticketmaster in the last decade, Simone?
Well, I have to admit, I'm often late to the game in buying concert tickets, so I'm the one going to like StubHub and figuring out how to get into this. True, but I mean, it's true. You're right. You point this out.
Simone Foxman, thanks very much for that. Turning now to the consumer space, or I guess away from regulatory. VF Corp, the parent company of Vans and North Face, reporting a fourth quarter loss along with 2 downgrades on the stock. Isabel Lee joins us with more. Isabel?
Hey, Matt, shares are edging even lower, now down to around 10%, and this is the lowest level since 2008. And of course, this comes after the company reported another loss. And this is really sending investor jitters because this marks the 7th consecutive quarter of falling sales. And to your point, we're talking about the owner of brands that many people know. This includes Vans, Dickies, North Face, and Timberland. The company reported a loss per share of 32 cents. This is compared to analyst expectations of a profit of 1 cent. Revenue decline across all margins led by Vans, which is the famous shoe brand, which is down by 26%. Adjusted gross margin also missed expectations. So the company said they're still working around a turnaround, and they're also working on cutting costs and paying down debt. But as we can expect, many in Wall Street weren't impressed at all. We have Williams Trading downgrading its recommendation on the stock, saying that it has a long way to go. We have Morningstar also saying there's little progress been made so far, and Telsley also cutting its rating. And at least to my count, there are at least 10 shops that cut its price target. This includes Citi and Bank of America. So really, it's not looking good for the firm. Yesterday also, I must point out that VF Corp announced a new CFO. That's Paul Vogel. He is going to take effect into the role on July 8th. But for now, shares are down 10%, and year to date also down 32%.
It's amazing that they're having these difficulties and getting these downgrades when yesterday alone I saw 3 people under the age of 30 wearing Jeff Spicoli's Vans. So at least it's on trend. Isabel Lee, thanks very much for joining us. Let's stick with apparel here. Ralph Lauren giving a 2025 forecast for revenue growth that fell short of analysts' estimates. Katie Greifeld joins us with more. Katie?
That is exactly the dynamic. We're talking about a strong quarter, but a tepid outlook, and you add it together, and shares are down. But let's talk about the quarter that was. Some of the actual numbers here. They reported adjusted earnings per share of $1.71 in the fiscal fourth quarter. That compares to the estimate of $1.66. You take a look at same-store sales, of course, an extremely important metric. They rose by 6%. The outlook had been, or rather the estimate had been for 5.1%. So another beat there. It was a really strong showing, especially from an apparel name right now when you think about that inflationary backdrop that we're living in. But let's talk about the forecast, of course. For fiscal 2025, the company sees revenue in constant currency growing 2 to 3%. Analysts had been looking for 4.4%, and that is what is sinking shares this morning. And this is a stock that's been outperforming year to date. As of yesterday's close, Ralph Lauren had been up 14%. That compares to an 11% gain for the S&P 500. This could be a situation of under-promise, over-deliver, the likes of Bloomberg Intelligence noting that the guidance may leave room for future upside, but for right now, shares down about 1.5%, Matt.
Katie, thanks very much. Katie Greifeld there on Ralph Lauren. Joining us now is Matt Miskin, co-chief investment strategist at John Hancock Investment Management. We talk, Matt, about a lot of different stocks there, but it seems like at least today, NVIDIA is the only thing that matters after the blowout earnings and raise that came out after the bell yesterday. What do you think about the AI sector?
Yeah, we almost think about it like a Seinfeld bit where it's like, why don't you just tell me where the earnings are going to be in terms of the analyst community looking for this stock and trying to project out, find out where these earnings are going. And they just keep underestimating the power of this business. So it's been really compelling to see. We have been overweight tech for much of the last 5 years. It's the strongest earnings in the world. It's lifting S&P 500 earnings. If you don't have tech in the S&P 500, you're probably growing earnings about flat. So it has been a huge earnings engine. It is something that we think is going to continue to hold up of the best earnings-wise, and that's why we still like the sector.
Is it too big? I mean, I'm getting messages from fund managers, I guess, who don't own NVIDIA, and they're angry about all the bullishness here. At some point, it's going to be overvalued, right? How do we get there?
Yeah, I mean, you're starting to talk about these numbers, and it's like 2 trillion to 3 trillion, and you were just referencing actually some of the market cap stats about how if this stock moves much more, you're adding it another business in terms of valuation. And yeah, I mean, it is starting to become rich, but especially if the rest of the market is struggling to show earnings, the ones that are powering ahead with earnings are going to get rewarded for that, and the valuations on a multiple basis aren't that terrible given their earnings growth. So there is going to be a time, but again, the margins on the business are 70%. You've got high cash balances on all these technology companies. They've got the balance sheet strength. We're seeing other companies. I mean, the last 24 hours is like a microcosm of the last couple of years. You've seen a lot of these retailers struggle with the consumer. You're seeing earnings misses on other kind of companies. The Fed is becoming more hawkish, but AI is saving the market.
I saw a great Onion headline this morning riffing off the Red Lobster shrimp story from the other day. Bankrupt Red Lobster runs all-you-can-grab copper wiring promotion. This is one of the other, I think, amazing stories in this market. Copper at an all-time high. And, of course, it plays a role in AI and the electrification of everything. What do you think about copper right now, Matt?
It's such a momentum trade. And really, I mean, we've gone from cocoa as a momentum trade to copper. And I do not see actually the fundamental support. You look back at the last periods where copper really rallied, they had a great support for it. So it was the Chinese, basically build out of all the cities, all the infrastructure, 2006, 2007, 2021, copper was at all-time highs with the coming out of COVID, the huge build out of the housing market and globally reacceleration. China right now is really struggling with the housing market. The fundamental support there, I mean, you might be knocking down cities and have a lot of extra copper lying around. You can reuse it. But at the end of the day, right now, there's momentum trades all over markets. it has become a very quantitative algo market, and you've got to be careful of whipsaws. Yesterday, copper was down about 5% after a huge rally. We're watching that closely today because if it's a follow through on the downside, we think there's going to be more meaningful downside follow through there. But it's one of these things, you know, you can get whipsawed easy in some of these pockets of markets today.
Well, but I mean, the record high in copper, the record high in gold, the S&P is up another 12%. You know, NVIDIA has doubled. Are financial conditions really constraining here? Is the Fed doing its job to bring inflation down?
That's the nasty side effect. And it's a great point. You know, I mean, financial conditions look easy. They are of the easiest. You know, if you go to the Bloomberg terminal and take a look at it in history, high yield spreads are under 300 basis points historically. That is exceptionally easy. The dollar's the only kind of, I'd say, mix to that. It is relatively strong, but the VIX is, you know, about 12. There is just a lack of risk being priced into markets today. And, you know, I get it. NVIDIA, one stock, has great earnings. Some other big tech companies have had great earnings, but broadly, there's pockets of risk out there. And we think we just came off a mini economic cycle from the Fed pivot just 6 months ago, and we're seeing deceleration of economic growth in the U.S. at least. We're going to see if globally that happens. But actually, Europe, the PMIs the last couple of days that just came out this morning were pretty strong. So it's a mixed backdrop. It's challenging on the macro side. We're just trying to follow the earnings at the end of the day.
Matt, great having you on the show. Hope we get you back. Matt Miskin there is co-chief investment strategist over at John Hancock Investment Management. In a sense, my alma mater, as I interned for Tucker Anthony about 100 years ago, which was a John Hancock company. Coming up, fresh PMI data about to cross the wires. We are breaking those numbers for you next with Michael McKee. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Well, Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
We have breaking U.S. PMI data coming in hot. Let's go to the Bloomberg International Economics and Policy correspondent with us again, Mike McKee, back in the studio. So, Mike, what do we see?
Well, the narrative that the economy is slowing down is not getting support from the S&P PMIs. The manufacturing PMI comes in at 50.9. It's the first time since 2022 it's been above 50. The services PMI 54.8 from 51.3, and the composite is 54.4 from 51.3. So improvement across the board with the PMIs. And of course, this follows on this morning's drop in jobless claims to 215,000. That is significantly down from the 230 some odd we saw a couple of weeks ago. That now looks like just a seasonal adjustment issue. So, Matt, we're still seeing strength in the economy, and the Fed's not going to move while we're seeing strength in the economy unless inflation comes down.
Or, I mean, if we continue to see strength in the economy and we continue to see inflation, supercore inflation trending higher, maybe they move to constrain financial conditions a little bit, because we are off to the races, it feels like, when you look at a lot of different data points.
Well, it's interesting because the Fed minutes of their May 1st meeting came out yesterday, and in those minutes they talked about questions about what effect the higher interest rates we've got are having on the economy. And some of them said, although monetary policy was seen as restrictive, many participants commented on their uncertainty about the degree of restrictiveness. Now, financial conditions don't necessarily reflect the real economy, they reflect what's going on Wall Street. But various participants mentioned a willingness to tighten policy further should risks to inflation materialize. Interesting, you'd think that would catch people's attention on Wall Street, but NVIDIA seems to be overcoming that. And you take a look at what's happened in the last 2 weeks, the odds of a rate hike on Wall Street, looking at SOFR futures, have come down. So at this point, the rate hike, even if the Fed was talking about it 3 weeks ago, doesn't seem to be a realistic possibility. The only question is, when does the Fed let us know that they might be willing to cut?
Do they have to cut eventually, Mike? I mean, we owe so much money that the carry costs are going to hurt if we have this higher for longer picture.
Well, if inflation didn't come down, they would keep things higher for longer, and they've look at where we are and say, look at the economy. It's doing just fine with rates where we are. The only issue for them is if we still see inflation coming down, then you get real rates moving up. And so they would want to cut rates at some point. One of the big topics, though, of discussion is where do they go? How far do they cut? And the general impression they've been giving over the last couple of weeks is not as far as people might hope or think.
All right, Mike, thanks very much. Bloomberg's Michael McKee, International Policy and Economics Editor. For some more of the sector price action, let's get to Bloomberg's Simone Foxman standing by. Simone, what do we see?
Well, Matt, it's all about NVIDIA. That's what you've been saying all morning, and that's what we see when we look at our IMAP function. Infotech, the sector up highest this morning, up 1.5%. Only energy slightly in the green. Everything else we're looking at in the red. It's a reminder that NVIDIA is 18.6% of the S&P 500 Infotech Index. Notably, when we think about NVIDIA's size and impact, its market cap, which crossed $2.5 trillion at the open, is actually now larger than Tesla's and Amazon's combined, larger than Canada's entire GDP, our Terrell Holt points out. Also watching the Philadelphia Semiconductor Index, that's 14% NVIDIA, but also we're seeing trading in ASML, AMD, other semiconductor shares higher in sympathy with this. Coherent, also a name that we're seeing trade higher this morning, Matt.
Yeah, fascinating stuff. Market cap of NVIDIA right now, $2.53 trillion. Fewer than 14 of those make up the total federal debt of the U.S., which is $34.5 trillion. Simone, thanks very much for joining us. Coming up, the market-moving events you need to be watching. That's next in our trading diary. This is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
names in global leadership are on Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Ratio.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
Corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. We have the skies opening here in New York City, so hopefully we'll survive this drenching here. Coming up, we're going to check in with Vince Signorella. He covers all the markets for Bloomberg News to figure out what he's seeing in the market. Shanna Sissel, President and CEO at Benrian Capital Management, joins us. We'll get her market call. And again, the CEO of HSBC US and America's Business, Michael Roberts, he's going to join us because he's chatting with Manish Krani from Bloomberg Television. We'll bring you those comments. So we got a lot of stuff. We'll break down the NVIDIA earnings as well. Another beat and raise, stock trading higher. That was a high bar, and they cleared it again. Let's kick everything off with Mr. John Tucker and a Bloomberg Radio.
All right, Paul and Alex, the major stock averages, they're actually mixed right now. The S&P 500, NASDAQ pairing some of the earlier gains. We'll go right to it. NVIDIA shares topping $1,000 after their blowout earnings after the close of regular trading yesterday. Most actively traded stock, best performing stock in the S&P 500 and the NASDAQ. And Dan Ives over at Wedbush Securities described NVIDIA's earnings results as a masterpiece.
They should hang in the roof. Because if you look at the guidance in terms of what we see on data center side, it was even, I think, $1 billion beyond whisper numbers. And if you look at the demand, this is the most important thing. Demand's accelerating. It's not even slowing down.
And NVIDIA shares right now up 8.5%, $1,030 per share. Live Nation among the worst performing stocks in the S&P 500 as the Justice Department seeks to break up Live Nation Ticketmaster. Live Nation shares right now down 3.2%. And DuPont plans to break up again. The company's going to separate its electronics and water units, forming a trio of publicly traded businesses. It's a process that's expected to take at least a couple of years. To bond shares right now, investors like the news, up 0.3%. On the economic front today, initial applications for unemployment benefits falling last week. First-time claims decreasing by 8,000. And names make news. James Gorman leaving his job as Morgan Stanley chairman at year-end. Right now, S&P 500, 2 points higher, 5309. The NASDAQ Composite Index, 81 points higher. That's up about 0.5%. And the Dow Jones Industrial Average, 233 points lower, and that is down 0.6%. And we're being brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest at ibkr.com/RIA. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. I'm Alex Steele, alongside Paul Sweeney and John Tucker. Did you hit new home sales?
No, I didn't.
Okay, well,
top of the hour. You know what? We're data dependent here at Bloomberg, and I blew it. I didn't give you data. Let's do that anyway.
You have the new home sales for month-on-month for April, but see, maybe I wasn't listening. That's why I asked you.
Why would you not be listening to me?
Every word.
I mean, I try to listen.
Coming up short of expectations, and that's a big drop month over month, down 4.7%. The prior reading was up 8.8%. That was revised down, but still 5.4%. So big drop there for new home sales.
I certainly didn't mean you had to do it. I was asking so I would do it and wasn't pointing out flaws, just so we're clear.
Well, we've got mortgage rates coming down. I'm looking at the 30-year. I mean, we're down at 7.01%. You know, was just, a few weeks ago up at, 7.3%. So still obviously way, way, way high, but
yeah,
coming down a little bit.
Yeah. Also, as John Tucker was noticing, a little pressure on stocks, particularly in the Dow. You have yields really moving higher after better than expected manufacturing services data from S&P Global. We're above 50 for both. That means expansion. So again, like we're firing on more cylinders than not within the economy, despite those new home sales.
I love you focusing on the eco things. I totally miss it. Like in surveillance, we think global, macro, geopolitical stuff. I forgot the whole eco screen.
I got you.
I got you. Thank you.
I got you, guys. That's why I'm here. That's why I come in. I do the sub relief. Anyway, so bond yields moving higher as the economy continues to do well, despite those new home sales that disappointed. Let's get more here with Vincent Signorella. He's Bloomberg macro strategist. Hey, Vincent, what are you making of the price action today? Like, yes, NVIDIA did really well. You're still seeing tech stocks holding on to those record highs. Bond yields creeping higher. What do you make?
Mm-hmm. I think what the market is looking at, and it's always the forward guidance situation. NVIDIA did forecast better sales for the second quarter in total. But I think what is the conversation that I'm hearing from people and going around the market is, is this going to be something that we saw about, the dot-com situation, if you will? Can AI maintain these huge margins? As this develops and becomes more mature, and it's not around the corner, of course, things get cheaper. And as things get cheaper, margins get squeezed, and the competition starts to come into the fray. And so the odds that NVIDIA maintains these margins going forward, I think, are shrinking, and I think that's what's taking the market back a little bit. And, you get comments also from Jamie Dimon, which I think, he's really pointing out something that people just don't want to see, is that inflation is sticky, and despite the S&P numbers we saw this morning, the economy seems to be slowing. So we're in the crosshairs of, a very delicate situation where things could roll over. And I think that's what we're starting to see here, is it's just a little bit of profit taking ahead of what are going to be some big numbers coming up at the end of the month on the 30th and 31st. Another run at U.S. GDP and PCE and personal income and personal spending data.
Hey, Vince, we've heard, Mr. Solomon at Goldman Sachs, we've heard Jamie Dimon and Mr. Moynihan at B of A start talking a little bit more about deficits, the national debt, things that I've heard my entire life, quite frankly. But now I'm hearing it from some of these big players saying, we got to start focusing on this stuff, really. I mean, when you talk to bond traders, currency traders, is that something you hear about?
Yeah, all the time. I mean, we're approaching a total debt level of near 35 trillion. And the part of that which is obviously making everyone anxious is, with yields at near zero, it was not much of an issue. With yields approaching 5% in the 2-year, the financing of that debt is becoming a bigger part of the budget. So you look at the United States budget every year, and you've got entitlements which aren't going anywhere, if not going higher. You got a huge military budget, and now you've got financing of the interest debt. All of that takes away from government spending that would typically go towards growth. And with that being reduced, then you have to look for the private sector to pick up the mantle on that. And I don't know that that's happening as much as it needs to be to keep the economy moving at the levels that we've seen. I think we're going to see enough growth to keep things going positive. I don't think we're necessarily going to see the Jamie Dimon hard landing, at least not in the second quarter. I mean, we'll take another look in the third quarter and the fourth quarter. It's not out of the realm of possibility. But, 0.1% drop in CPI is not a trend in changing inflation. We saw that in September of last year, and then we saw 5 months in a row of increases in CPI. So, the folks at the Fed who are thinking, that inflation may have turned a little, I think are very, very premature. I think we need to see many more months of data before we see where the trend in inflation is.
So here is my very sophisticated question on that, knowing that you are a macro strategist and you traded FX for your whole career. How much more upside is there in NVIDIA then? It's like super micro. And I'm joking, but I say that because in the scenario that you laid out, I feel like we've been waiting for that to sort of take hold in the market, right? And it hasn't in the same way. And these stocks, in general, tech and other stocks, other sectors seem to be very resilient to those higher bond yields.
So this is like my feeling about that is, number one, is AI here to stay? Absolutely. Is AI a bubble? Absolutely. I think we are going to revert, and we saw this some 20 odd years ago. We're going to revert to fundamentals. We're going to go back to the basics. And as much as the darlings of AI and NVIDIA and Snowflake and such are driving gains at the moment, the reality is people really need to look at the bigger picture. You're not going to really see one stock, which is something I think of 5.5% of the S&P at the moment in terms of gains. That one stock is not going to be able to pull the carriage, forever. And it's going to be whether the economic growth cycle continues, whether inflation starts to perk up again. All of those things, I think, are going to attack the gains that we're seeing in technology and AI and are going to stymie that growth. And I'm feeling like the market's trading right now that's going through their mind.
Yep.
Are we near the highs? Have we made the highs?
Yep.
It's definitely a conversation.
All right, Vince. Excellent. As always, appreciate your thoughts. Vince Signorella, Bloomberg macro strategist, joining us from the home office, which is a killer home office for Vince Signorella. He has mastered that home office stuff. Let's switch gears. Let's get right to our next guest, Shanna Sissel, President and CEO of Bonrion Capital Management, joining us from Chicago via this Zoom thing. Shanna, thanks so much for joining us here. I mean, I guess the story of the day this morning is NVIDIA, another beat and raise, as the kids say. What did you take away from the earnings last night?
It wasn't the earnings that I was most surprised by. I think we all expected them to beat. It was somewhat built into the stock price. Aftermarket, it didn't move that much. Obviously now it is. But I think that the thing that shocked me most was the 10-for-1 stock split announcement. That surprised me. Not because it's not unusual for a company to want to split in a way that would make their stock price under $100 again and make them more attractive to retail investors, make it easier for their employees to take advantage of their stock compensation and a variety of other reasons. But in the world of fractional shares, it's not as necessary, which is why we see so many stocks trading at $500, $600, $700, $8,000. I mean, Chipotle is like over $3,000. So that actually surprised me the most. But the earnings weren't particularly surprising. Obviously, it was above consensus estimates, but there was a whisper number, and the numbers that they reported were close to that whisper number. And so, I think the real problem here is how long can they keep doing this. This is the third straight quarter that they've reported greater than 200% year-over-year revenue growth.
Yeah, and I feel like we've been asking that question for the third straight quarter, too, so you're not alone. I was really struck by a note that came out today. Man, it's time for spring break. NVIDIA's done. We got nothing going on until June 7th, which is Jobs Day. It is time for spring break. Do you subscribe to that view?
I don't. I'm always following the markets. There's always interesting things going on. Obviously, as you said, the next big report is in June, but there's opportunities for here to take a breather. But I think this is a great opportunity to start looking for new opportunities to get into stocks as people are taking a breather. And so I use this time to kind of do my work and figure out what my best ideas are going to be going forward.
Shanna, do your best ideas include small cap stocks?
So right now, small caps have some technical issues. They have, I think they're in the third longest streak of negative, not reaching a new high. And they have really struggled to get out of the funk that they're in, which is unusual in many ways. And it might be a reflection of some change in market dynamics, especially the concentration in the large caps that Mag 7 kind of feel and what's driving it. But small caps are interesting because if you look at the data, it's the actively managed and the factor-based small cap types of ETFs and mutual funds that are outperforming, and substantially so. So this whole idea that active management is dead and that you don't need active management in your portfolio in order to do well, I think needs to be reconsidered, because in a place like small caps where there's a lot of inefficiencies and opportunities for smart money and those who are actually doing work on individual names to outperform, I think that we should reconsider ways that we build portfolios, and active management right now is really working in the small cap space.
So where in the small cap space is it sector specific? Is it balance sheet specific? Is it a growth value kind of thing?
It's more factor based, so like quality, but even it has to be even higher quality, because the active managers are beating the S&P 600, which tends to be higher in quality than the Russell 2000, which tends to be full of a lot of like junk and penny stocks and things of that nature. So we're seeing that in active management. We're seeing it in the quality factor, you're seeing it in the momentum factor, but you're seeing it more in the factors than in like growth value and more than style per se.
Hey, Shanna, what are you guys doing in fixed income? I mean, I can sit in a 2-year treasury and get close to 5% here with no risk. Do I sit there or do I go out on the credit curve a little bit?
So we, being focused on alternatives, we're looking more at the private credit and private debt markets, some interesting opportunities in real estate income. And with the advent of interval funds, it allows us the opportunity to gain exposure to those types of credits, even for clients that aren't qualified or accredited. So there's a Pender Capital has a real estate debt fund that is an interval fund that allows for the average investor to gain exposure to an area in private credit that was not traditionally available to that space. And there's others like that. So for us, that's kind of where we're playing, because that's where the real opportunity lies. Rates are kind of volatile right now, and as you said, you can get really good yield in treasuries, but we're seeing a lot of demand in the non-traditional credit markets and the non-bank lenders, because the credit markets after the financial crisis kind of seized up for a lot of potential businesses, small business and such. So the private debt markets have real opportunity to get above average yield with relatively good credit.
Quickly before we let you go, when you look at alternatives like that also include like gold, and I say that because man, gold has been on a tear. Like, is that part of the portfolio?
Oh, absolutely. Commodities are part of the portfolio. Gold and copper are really interesting right now. Gold hit all-time highs yesterday. I would also put crypto in that space. So Bitcoin, and there's a lot of chatter right now about the probabilities of the spot ETH ETF being approved this week or next week. I know your colleague Eric Balkunas has been writing a lot about it. So it's one of those things where crypto is also quite interesting right here. But yeah, those are all alternatives, and those are all things we consider for portfolios.
All right, thanks a lot. Really appreciate it. Thank you for jumping on with us. Shayna Sissel joining us, President and CEO of Banurion Capital Management, joining us from Chicago, Illinois. That probably, oh, hey, the sky just lightened.
Oh, it did.
We were getting like
I
a
thought we weren't gonna
deluge,
survive this.
like Noah's Ark kind
Yes.
of rain. Okay, now it seems to be pairing a little bit there. All right, coming up, Michael Roberts, HSBC US and America's CEO, will be speaking with Bloomberg's Manus Cranny. We're going to bring you that interview on a day where it's post-NVIDIA, and you got to ask, do you just kind of chill a little bit until June 7th? That's the next jobs day. Is it spring break if you're an equity investor? Stuart Kaiser thinks so over at Citi. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. It's an everything tech rally. NVIDIA's blockbuster results confirming that artificial intelligence is going to remain the driving force supporting tech stocks into the second half of this year. Now, if NVIDIA's advance holds today, chipmakers set to add more than $100 billion in market value. You also have a lift of the hardware stocks like Supermicro and Dell. They're also getting a lift. The major averages, the advances are muted in the S&P 500. NASDAQ 100 are on track for records. S&P 500 right now up just a point, 53.08. The NASDAQ 100, 85 points higher. That's up 0.5%. And the Dow Jones Industrial Average lower by 260 points. That's a decline of 0.7%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast. Well, our good friends at HSBC, they're unveiling their new U.S. headquarters in Hudson Yards in New York City. Its leadership is hosting an opening ceremony at the Spiral at Hudson Yards. And earlier, Bloomberg's Manish Krani was joined by Michael Roberts, HSBC's U.S. and America CEO, in a wide-ranging conversation. They discussed everything from Fed policy to China tariffs. Manish began by asking Michael about how China tariffs from President Biden or a new administration would affect commercial banking flow from the U.S. into China. Let's take a listen.
Clearly, we're in a period of rising tariffs, rising quotas. Don't know what the Chinese response will be to the latest tariffs put on by the U.S. But, you know, trade liberalism is certainly in a different phase than it was in the past. So I think we have to accept that. Our companies have to accept that. So a couple of responses. One, we're there to provide that advice. We're the largest trade bank in the world. We have abilities to really help companies manage their trade wherever they may be. So if a client is exporting from China, as an example, and wants to move that production capacity outside of China, we can help them. We're the largest foreign bank in India. We're a significant bank in Vietnam, a very big bank in Mexico. So we're really there to help them navigate through this unpredictability. I think that will continue. Regardless of what happens in the elections, we will have more tariffs, more quotas, a less easy trade environment to navigate going forward.
If I said to you, what's the biggest lever for the business in the near term?
Yeah.
Is it going to be rate cuts from the Fed or a clarity in politics and tariffs?
I think it's both. I think you need predictability. Companies need predictability to make their investments. Investors need predictability. What we haven't had really is that predictability. Lots of discussion on interest rates, lots of discussion of when and by how much. Now you've got the quota uncertainties. I think policy needs to be predictable. So if there's a rate cut, fine. If there's not, then it's the question of how companies then react to that. How do they then build their businesses to exist in a rate environment which is higher than it has been the last 15 years, but I would argue that the last 15 years have been an abnormal rate environment. So if they have that predictability, they can adjust their own production, they can adjust how they run their companies, and I think they'll do much better, but they need policy predictability.
But herein lies the point for the commercial bank. Let's just square that away, which is many people say to me they've refinanced a great deal, have refinanced on the retail private side.
Yeah.
Do you think that's the same for corporates? Are they holding back on doing deals, doing M&A, doing debt capital markets as a result of uncertainty?
Yeah, I think they were in the past. I think last year was certainly a reflection of that uncertainty.
And we've jumped over that now.
We have jumped over it. If you look today, the capital markets are on fire. We've had $750 billion of issuance in the debt capital markets for investment grade. Spreads are the tightest they've been in a long, long time. A lot of CLO formation of capital for the non-investment grade market, which I think will continue. And even the equity market. We've seen a lot more IPOs, led by the tech sector, of course, but IPOs are trading very nicely now. A lot more activity. So I think that sense of predictability is coming back. Yes, and people have gotten over whether it be 6, 5, 4, 3, 2, 1, interest rate cuts. I think they're saying, you know what? It's going to be a 3.5% to 5.5% interest rate environment. We just need to adjust to that.
Put your marker down. Rate cuts this year?
I think if you get one, you're probably doing pretty well. And that's what our house view is. My personal view, you'll get one, maximum.
So with that kind of a bullish outlook, then what is the flow? What does the flow and the book look like here on the floor? Because that's a very bullish statement about the market. Where are you in quarter two?
Yeah, we're doing well. I mean, there's been a lot more activity. both in the debt and equity capital markets. So we feel very comfortable where we are. And our goal really is to support international companies coming into the United States, and as well as helping those companies raise capital here, helping our companies raise capital elsewhere as well.
Well, if I said to you, let's push back on that a little bit, because if you look at where you are in debt capital markets and equity capital markets, I would say to you, look, you're not in the top 5. You know, you're quite away from the top 5. Do you want to be in the top 5? What is the ambition for DCM and ECM in that sense?
I want to be good for our clients. I've never been a league table guy. I want to focus on helping our clients in the way that we need for them to help. So as an example, we're going to support a company from the emerging markets who's going to be buying a company in the United States. That we need to do from an advisory perspective. We're going to raise debt in the United States. That is exactly the type of transaction that we were going to focus on. Similarly, we're helping a company, U.S. company, buy a company in the U.K. So we'll use our expertise and our insights, our capabilities in the U.K. market to raise that capital as well. So league tables, don't really look at them. It's really how do we serve our clients? Do we do it well? And do we do it in such a way that we provide them value?
But then the natural corollary to that is if you're not sort of focused on being on the top 5, my question would be is, do you have the right scale to fill this house down in Hudson Yards? Because obviously it's not the same story in Asia as it is here. This is a very different capital markets to what's happening in Asia at this moment in time. So are you, again, going back to fit for purpose, right size on those teams here in the U.S.?
Completely. In fact, as you look around this trading floor, it's pretty full. We've got about 400 traders here.
So you would say no cuts in America in jobs in those businesses?
I would say we're fit for purpose, and we will always, change, we'll always react. It's a dynamic process, but we're fit for purpose because you have to really look at our operations are here to serve not only our, what we do in the U.S., but globally. So if there is need to raise capital around the world, you've got to come to the U.S. markets. So we serve HSBC as the center of an activity in the largest capital markets in the world. I would argue you can't be a global bank without being very relevant in the United States. We are relevant to our clients in the United States. We're also relevant and very important for HSBC.
To accelerate that bump that you've had in business, do you think rate cuts will re-accelerate that? I know you're on the table for limited cuts, but do you think a shift in the rate environment can materially shift the business?
I think rate cuts will be important, but not determinant. So I think, yes, it's important to have rate cuts. Again, I'll go back to this predictability statement. If rate cuts come, it provides predictability. I think you'll see the capital markets grow even more. I think they're poised to do so. As I mentioned, lots of capital formation, money sitting on the sidelines, but it wants to be put to work. So as soon as we can see predictability, I think you'll have even greater growth in the capital markets, both debt and equity. And I think we're well positioned to take advantage of that. We've got lots of discussions going on. Lots of sentiment is turning positive today. And they're looking for that opportunity to fully exploit.
So we caught up with David Solomon. We wrote a story from him yesterday, and we caught up with him in Paris. What can you tell me about middle America corporate and middle America? Because he says higher rates, higher for longer is beginning to bite. Is it?
I think it's beginning to bite, certainly for consumers. And, if you think about it, over the last years, we've had successive years of inflation, call it 15% on a cumulative basis. Wages haven't gone up by 15%. So, yeah, it is biting for certain segments of the population, which is policymakers and as bankers we have to be very sensitive to. I think for our clients, they've adjusted. Again, historically, these are rates that we have historically seen, 3.5%, 4%, 5%. And so if they can adjust to those rates, I think they can do pretty well. So we don't see a lot of stress in our credit books. We don't see companies, giving up and saying that it's too difficult an environment. They're, I think, being a little cautious until they see rates and where they're going. But they're not stopping doing business. They're not stopping to grow. And they have a view that as long as they can manage in this rate environment, they know where the rates are going, they know where the economy is going, they have policy predictability, I think they'll be okay.
So let's talk about the elephant in the room. The chairman will be here. I have it on good authority.
The chairman will be here today.
A little bit later on. Yeah, sure. He's searching for his third CEO in 7 years.
Yes.
The 3 predecessors. Is it time for a yank?
Time for a yank? I don't know. Thank you very much. As an American, I appreciate that. I'd say this. One, Noel was a great boss, Noel Quinn. He and I took our respective roles about the same time, so we worked very closely. He was a great supporter of me. He was a great supporter of this franchise, and really an inspiring boss to work for, and did a fabulous job. Mark Tucker is leading an effort along with the board. They're very focused on getting the right person. I don't think.
I mean, look, you've been here. You've reconstructed this bank in North America. Do you think it is better culturally and for the people of HSBC to have an internal person versus another new person come in?
Yeah, and look, I think we've got a lot of good internal candidates. I think there clearly is an advantage for having someone who knows the institution. I think the board's going to take that into consideration. They already had a succession plan worked out. They were very focused on making sure that they would have a very quick, efficient, and very targeted succession plan. They're looking at both external and external candidates. Their decision, obviously. But I think, very important that you bring the right person in who has the right culture, the right mindset, and the right set of skills.
That was Michael Roberts, HSBC U.S. and America's CEO, speaking with Bloomberg's Manus Cranny, joining us. That great interview. We really appreciated that. All right, let's get back to the markets here. NVIDIA, that stock still up 10% despite a little bit of rockiness within the market. We're going to break down earnings and what it means for broader tech. What happens when competition actually comes in? Kujan Sobhani is Bloomberg Intelligence Senior Semi-Analyst. He will be joining us. Let's go to Michael Barr now with World and National News.
Thank you very much, Alex. Paul, John. Former Republican presidential candidate Nikki Haley says this November she'll be voting for her former opponent, Donald Trump. The one-time UN ambassador under former President Trump built a campaign around wooing independents, moderates, and anti-Trump Republicans. Haley criticized President Biden's handling of Israel, the border, the economy, and more, saying that's why she's backing Trump.
I put my priorities on a president who's going to have the backs of our allies and hold our enemies to account, who would secure the border, no more excuses, a president who would support capitalism and freedom.
Nikki Haley spoke before the conservative think tank, the Hudson Institute. The Senate will have a floor vote on border security legislation today. Bloomberg's Amy Morris brings us a preview from Washington.
Senate Majority Leader Chuck Schumer is looking to pass border security legislation as a standalone bill. He says senators face an important decision.
Will both sides come together to advance a bipartisan border security bill, or will partisanship get in the way once again?
Republican Senator James Lankford helped negotiate the bill.
It's going to be a slimmed-down bill. Whatever we can do, it'll be something slimmed down on the essentials.
Republicans are expected to block it, but that would give Democrats something to campaign on this election year. In Washington, Amy Morris, Bloomberg Radio.
Justice Samuel Alito is under fire once again after another photo in the New York Times shows a flag connected to the January 6th rioters flying outside his beach home in New Jersey. Some politicians have also flown the pine tree flag, including House Speaker Mike Johnson, saying he appreciates the flag's history. However, dozens of Democrats say Alito is a judge, not a politician, and want Alito to recuse himself from January 6th cases. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. In the driver's seat for markets, NVIDIA results, and also yields. Treasury selling off after the economic data showed business activity accelerated. You had a pickup in inflation as well, with a rise in bond prices, the rise in yields right now, two-year yield, that's more policy reactive. That's 7 basis points higher. Right now, 4.94. The 10-year is up 6 basis points at 4.48. Now back to NVIDIA, the most active and best performer in the S&P 500 as well as the NASDAQ, trading up over $1,000 a share after reporting after the close yesterday. And analyst Matt Bryson at Wedbush Securities says NVIDIA did deliver on all fronts.
There's nothing not to like. They gave us a great guide. They gave us great results. They told us that they